improving how capital money is allocated. For businesses, using a single set of accounting standards reduces costs and simplifies international reporting. Summary of acronyms: IFRS, International Financial Reporting Standards; IASB, International Accounting Standards Board; IFRS Foundation, the organization that oversees the IASB and the development of IFRS standards. In summary, the conceptual framework is like a foundational guide that helps create clear, consistent, and reliable financial reporting rules. It helps the IASB develop these rules, helps companies apply them when there's no specific rule, and helps everyone understand and interpret them. This framework supports global financial transparency, accountability, and efficiency, making it easier for investors and other stakeholders to make informed economic decisions. The history of the conceptual framework for accounting and financial reporting. Early accounting practices. Long before there was a formal framework, accounting practices varied widely. Different countries and even different companies had their own ways of recording financial transactions. This inconsistency made it difficult for investors and other stakeholders to understand and compare financial statements. Need for standardization. The lack of standardized accounting practices led to calls for a more uniform approach to financial reporting. The idea was to create a common language for accounting that everyone could understand and trust. This was particularly important as businesses started to operate internationally, and investors needed reliable financial information from companies in different countries. Formation of the International Accounting Standards Committee, IASC. In 1973, a significant step was taken with the formation of the International Accounting Standards Committee, IASC. This organization was established by accounting bodies from 10 countries, including the United States, Canada, the United Kingdom, Australia, and Japan. The IASC's mission was to develop and promote international accounting standards. The introduction of IAS. The IASC began issuing standards known as International Accounting Standards, IAS. These standards aimed to bring consistency to financial reporting across different countries. While IAS helped, there was still a need for a conceptual framework to underpin these standards and guide their development. The conceptual framework, an emerging idea. The idea of a conceptual framework started to gain traction in the 1970s. The framework was envisioned as a coherent system of interrelated objectives and fundamental principles. It would guide the development of accounting standards, ensure their consistency, and help in interpreting and applying them. The FASB's role in conceptual framework development. In the United States, the Financial Accounting Standards Board, FASB, took the lead in developing a conceptual framework. The FASB began this project in the mid-1970s. They published several documents outlining their thinking on the objectives and fundamentals of financial reporting. These documents formed the basis for the FASB's conceptual framework, which was finalized in the 1980s. The IASC's efforts. Inspired by the FASB's work, the IASC also began to develop its own conceptual framework. The goal was to create a framework that would guide the development of IAS and ensure they were based on consistent principles. The IASC started this project in the 1980s, but progress was slow due to the complexity of the task and the need to reach international consensus. Transition to the IASB. In 2001, the IASC was restructured to create the International Accounting Standards Board, IASB. The IASB took over the responsibility of developing international accounting standards and completing the conceptual framework project. The IASB's framework was intended to serve as a foundation for the new International Financial Reporting Standards, IFRS, that they would develop. The 2010 Conceptual Framework. The IASB, working closely with the FASB, issued an updated conceptual framework in 2010. This framework outlined the objectives of financial reporting and the qualitative characteristics that financial information should have, such as relevance, faithful representation, comparability, verifiability, timeliness, and understandability. Key components of the conceptual framework. 1. Objectives of financial reporting. The primary objective is to provide financial information that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. 2. Qualitative characteristics. Relevance. Financial information must be capable of making a difference in decision-making. Faithful representation. Information must be complete, neutral, and free from error. Comparability. Users should be able to compare financial information across different entities and periods. Verifiability. Independent observers should be able to reach a consensus that the information is faithfully represented. Timeliness. Information should be available in time to influence decisions. Understandability. Information should be presented clearly and concisely. 3. Elements of financial statements. The framework defines the basic elements of financial statements, such as assets, liabilities, equity, income, and expenses. 4. Recognition and measurement. The framework provides guidelines on when and how these elements should be recognized in financial statements and how they should be measured. Continuous improvement. The conceptual framework is not static. It is periodically reviewed and updated to reflect changes in the economic environment and advancements in financial reporting practices. The IASB continues to refine the framework to address new challenges and ensure it remains relevant. 2018 revision. In 2018, the IASB issued a revised conceptual framework. This update provided clearer definitions of key elements, updated the recognition and measurement concepts, and added a new chapter on presentation and disclosure. The revisions aim to improve consistency and provide more comprehensive guidance for standard setters, preparers, and users of financial statements. The role of the IFRS Foundation. The IFRS Foundation oversees the IASB and its work, including the development and maintenance of the conceptual framework. The Foundation's mission is to develop high-quality standards that promote transparency, accountability, and efficiency in global financial markets. In summary, the conceptual framework for financial reporting has a long and evolving history. It started with the need for standardized accounting practices, leading to the formation of the IASC and the development of IAS. The restructuring into the IASB and the introduction of IFRS brought about a more structured approach to financial reporting. The conceptual framework serves as the foundation for these standards, guiding their development and ensuring consistency. Over time, it has been refined to address new challenges and improve the quality of financial reporting worldwide. The IFRS Foundation continues to oversee this work, ensuring the framework and the standards remain relevant and effective in promoting global financial stability. Welcome back. Welcome back, everyone. I hope you all had a great week. In our previous lectures, we explored the basics of the conceptual framework for financial reporting and delved into its historical development. Today, we will move forward with our syllabus and begin discussing the first chapter, the objective of general-purpose financial reporting. Syllabus overview. Here's a brief overview of the contents we will cover in this chapter. 1. The objective of general-purpose financial reporting. Introduction. Objective, usefulness, and limitations of general-purpose financial reporting. Information about a reporting entity's economic resources, claims against the entity, and changes in resources and claims. Economic resources and claims. Changes in economic resources and claims. Financial performance reflected by accrual accounting. Financial performance reflected by past cash flows. Changes in economic resources and claims not resulting from financial performance. Information about the use of the entity's economic resources. Introduction. The objective of general-purpose financial reporting forms the foundation of the conceptual framework. Other aspects of the conceptual framework, the qualitative characteristics of, and the cost constraint on, useful financial information, a reporting entity concept, elements of financial statements, recognition and derecognition, Measurement, presentation, and disclosure flow logically from the objective. Detailed explanation of the introduction. Let's break this down to ensure we understand it thoroughly. 1. Objective of general purpose financial reporting. This is the cornerstone of the conceptual framework. It defines why we create financial reports in the first place. The primary objective is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. 2. Flow of the conceptual framework. The objective influences all other aspects of the conceptual framework. For example, qualitative characteristics. These are the attributes that make the financial information useful. They include relevance, faithful representation, comparability, verifiability, timeliness, and understandability. Cost constraint. This concept acknowledges that while providing useful financial information is important, it must also be done cost-effectively. Reporting entity concept defines what constitutes the entity for which financial information is provided. Elements of financial statements includes assets, liabilities, equity, income, and expenses. Recognition and derecognition concerns the criteria for including or excluding items in the financial statements. Measurement refers to the basis on which financial elements are quantified. Presentation and disclosure relates to how information is displayed and the details provided to users. Example for better understanding. Imagine you are an investor considering whether to buy shares in a company. You would need comprehensive and reliable financial information to make an informed decision. The company's financial statements provide this information, reflecting the company's economic resources, assets, claims against those resources, liabilities and equity, and changes in those resources and claims over time. For instance, suppose the financial statements show a significant increase in the company's revenue over the past year. This information can be crucial for your decision-making process. However, this revenue data must be relevant, related to your decision-making needs, faithfully represented, accurate and complete, comparable, consistent with other companies, and timely, current enough to be useful. Conclusion. Understanding the objective of general-purpose financial reporting is essential because it sets the stage for all other elements of the conceptual framework. By ensuring that financial reports meet these objectives, we can provide valuable information that aids investors, lenders, and other stakeholders in making informed decisions. Objective, usefulness, and limitations of general-purpose financial reporting. This topic is crucial as it dives deeper into why financial reporting is essential and the factors that influence its effectiveness. Objective, usefulness, and limitations of general-purpose financial reporting. Objective. The primary objective of general-purpose financial reporting is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors. This information helps them make informed decisions regarding providing resources to the entity. These decisions include 1. Buying, selling, or holding equity and debt instruments. Investors need to decide whether to buy, sell, or hold shares or bonds based on the financial health and performance of the entity. 2. Providing or settling loans and other forms of credit. Lenders need to assess the entity's ability to repay loans or settle other forms of credit. 3. Exercising rights to vote on or influence management's actions. Investors may use financial information to decide how to vote on management decisions that affect the entity's economic resources. Example: imagine an investor considering buying shares in Company X. The investor will review Company X's financial reports to understand its profitability, debt levels, and cash flow. This information helps the investor decide whether Company X is a good investment. Usefulness. To be useful, financial information must help existing and potential investors, lenders, and other creditors assess. 1. Returns expectations. This involves understanding the amount, timing, and uncertainty of future net cash inflows, such as dividends, interest payments, or market price increases. 2. Management stewardship. This assesses how efficiently and effectively the management has used the entity's economic resources. Example: consider a lender evaluating a loan application from Company Y. The lender will look at Company Y's financial statements to assess its ability to generate enough cash flow to repay the loan. Additionally, the lender will evaluate how well the management has managed Company Y's resources in the past to predict future performance. Information needed for assessments. To make these assessments, users need information about 1. Economic resources and claims. This includes details about the entity's assets, liabilities, and equity, and how these have changed over time. 2. Management's efficiency and effectiveness. This involves evaluating how well management has discharged their responsibilities in using the entity's economic resources. Example: suppose an investor is looking at Company Z. The investor will review the balance sheet to see the economic resources, assets, and claims against those resources, liabilities, and equity. They will also examine the income statement to assess how efficiently and effectively the management has generated profits. Limitations. General-purpose financial reports have limitations. They cannot provide all the information users need and must be supplemented with other sources, such as 1. General economic conditions and expectations. The broader economic environment impacts the entity's performance. 2. Political events and climate. Political stability or instability can influence the entity's operations. 3. Industry and company outlooks. Industry trends and company-specific factors also play a role. Example: an investor considering Company A must not only look at its financial reports, but also consider the current economic conditions, such as inflation rates and industry trends, which could affect Company A's future performance. Not a valuation tool. General-purpose financial reports are not designed to show the exact value of a reporting entity. Instead, they provide information to help users estimate the entity's value. Example: an investor cannot determine the exact market value of Company B solely from its financial reports. However, the reports provide essential data, such as revenue, expenses, and cash flows, which the investor can use to estimate the company's value. Primary users. Primary users of general-purpose financial reports include existing and potential investors, lenders, and other creditors who cannot obtain financial information directly from the entity. Management, although interested, can obtain internal financial information and does not rely solely on these reports. Example: shareholders of Company C rely on general-purpose financial reports to make decisions as they do not have direct access to the company's internal financial data. Management, on the other hand, can access detailed internal reports for decision-making. Estimates, judgments, and models. Financial reports are often based on estimates, judgments, and models rather than exact figures. The conceptual framework establishes the concepts underlying these estimates and judgments, guiding the preparation of useful financial information. Example: depreciation expense in Company D's financial statements is based on estimates of the useful life and residual value of its assets. These estimates require management judgment and are guided by the conceptual framework principles. Conclusion. Understanding the objective, usefulness, and limitations of general-purpose financial reporting is essential for interpreting financial statements. While these reports provide valuable information, they are not exhaustive and must be considered alongside other relevant factors. Information about a reporting entity's economic resources, claims against the entity, and changes in resources and claims. This topic is crucial as it helps users understand the financial position and performance of an entity. Information about a reporting entity's economic resources, claims against the entity, and changes in resources and claims. 1. Economic resources and claims. Explanation. Information about the nature and amounts of a reporting entity's economic resources, assets, and claims, liabilities, and equity helps users identify the entity's financial strengths and weaknesses. This information is crucial for assessing liquidity, ability to meet short-term obligations, and solvency, ability to meet long-term obligations. It also helps users understand the entity's need for additional financing and its likelihood of obtaining that financing. Additionally, this information aids in assessing management stewardship of the entity's economic resources. Example: imagine a company with significant accounts receivable, economic resources, and a large amount of short-term debt, claims. The accounts receivable represent future cash inflows, indicating potential liquidity. However, the short-term debt signifies immediate cash outflows, impacting the company's solvency. Users can assess whether the company can meet its obligations without additional financing. 2. Changes in economic resources and claims. Explanation: changes in a reporting entity's economic resources and claims result from its financial performance and other events or transactions, such as issuing debt or equity instruments. Users need to distinguish between changes resulting from financial performance and those from other events to assess future cash inflows and management stewardship effectively. Example: if a company issues new shares, equity instruments, this increases its equity without reflecting financial performance. Conversely, an increase in retained earnings from profitable operations reflects the company's financial performance. Users need both types of information to understand the entity's overall financial position and performance. 3. Financial performance, reflected by accrual accounting. Explanation: accrual accounting records the effects of transactions and events in the periods in which they occur, regardless of cash flows. This approach provides a more accurate basis for assessing an entity's past and future performance by showing changes in economic resources and claims during a period. Example: consider a company that makes a large sale in December but receives payment in January. Accrual accounting recognizes the revenue in December when the sale occurred, providing a better picture of the company's performance in that period. This information helps users assess the company's ability to generate future net cash inflows. Lesson 4. Financial performance reflected by past cash flows. Explanation: information about past cash flows helps users assess an entity's ability to generate future net cash inflows and management stewardship. This information shows how the entity obtains and spends cash, including borrowing, repaying debt, and distributing dividends. Example: reviewing a company's cash flow statement, users can see that it has generated significant cash from operations, but also has high debt repayments. This indicates that while the company is generating cash, it is also using a substantial portion to service debt, affecting its liquidity and solvency. 5. Changes in economic resources and claims not resulting from financial performance. Explanation: changes in economic resources and claims can also result from events other than financial performance, such as issuing debt or equity instruments. This information is necessary for a complete understanding of the changes in the entity's financial position and their implications for future performance. Example: a company might issue new bonds, increasing its liabilities, claims, without affecting its financial performance. Users need to understand this to accurately assess the company's future financial performance and its ability to meet new debt obligations. Conclusion: understanding the information about a reporting entity's economic resources, claims against the entity, and changes in resources and claims is vital for making informed decisions. This information helps users assess the entity's financial strengths and weaknesses, predict future cash flows, and evaluate management stewardship. Today, we will discuss the final topic of Chapter 1, information about use of the entity's economic resources. Information about use of the entity's economic resources. Explanation: information about how efficiently and effectively the reporting entity's management has discharged its responsibilities in using the entity's economic resources is crucial. This information helps users assess management stewardship and predict future performance. Efficient and effective use of resources indicates competent management, which is vital for the entity's prospects for future net cash inflows. Examples of management's responsibilities. 1. Protecting resources from unfavorable effects. Economic factors. Management must safeguard the entity's resources from adverse economic factors, such as price fluctuations and technological changes. For example, if a company is in the technology sector, management must stay ahead of technological advancements to avoid obsolescence. Example, consider a smartphone manufacturer that regularly invests in research and development, R&D, to stay updated with the latest technology trends. By doing so, the company protects its market share and ensures its products remain competitive. 2. Compliance with laws, regulations, and contractual provisions. Legal and regulatory compliance. Management must ensure the entity complies with all applicable laws and regulations. Non-compliance can result in fines, legal battles, and damage to the entity's reputation. Example, a pharmaceutical company must comply with stringent regulatory standards for drug safety. By maintaining compliance, the company avoids legal issues and potential recalls, which can be costly and damage its reputation. Contractual compliance. Management must also ensure the entity meets its contractual obligations to avoid breaches that could lead to penalties or loss of business relationships. Example, a construction company has a contract to complete a project within a specified time frame. By managing resources effectively and adhering to the timeline, the company fulfills its contractual obligations, ensuring client satisfaction and future business opportunities. Predicting future efficiency and effectiveness. Evaluating how management has used the entity's resources in the past provides insights into their capability to manage resources in the future. If management has demonstrated a track record of efficiently and effectively using resources, it increases confidence in their ability to continue doing so, which is crucial for assessing the entity's prospects for future net cash inflows. Example, let's consider a retail company that has consistently increased its inventory turnover rate over the past few years. This indicates that management has been effectively managing inventory levels, reducing holding costs, and ensuring products are sold before becoming obsolete. Such efficiency can be a strong indicator of management's ability to sustain or even improve performance in the future. Conclusion. Understanding how management uses the entity's economic resources is vital for assessing their stewardship and predicting future performance. This information helps users make informed decisions about providing resources to the entity. Chapter 1. General Purpose Financial Reporting. In this chapter, we have explored the fundamental concepts of general purpose financial reporting. We began by understanding the objective, which is to provide useful financial information to investors, lenders, and creditors. This information helps them make informed decisions about providing resources to the entity, such as buying securities or extending credit. We discussed the importance of financial reports in providing information about a reporting entity's economic resources, claims against the entity, and changes in these resources and claims. This information helps users assess the entity's financial position, performance, and management's stewardship of resources. We also highlighted the role of accrual accounting in providing a more accurate depiction of financial performance over cash-based accounting. Furthermore, we examined how financial reports are not only tools for decision-making, but also have limitations. Users must supplement financial reports with other sources, such as economic conditions and industry outlooks, to gain a comprehensive understanding. Lastly, we explored how information about the use of the entity's economic resources helps users evaluate management's effectiveness and predict future cash flows. Management's responsibilities include protecting resources from economic factors and ensuring compliance with laws and regulations. Support and engagement. Thank you for joining us in this lecture. Your understanding of these concepts is crucial for navigating the complexities of financial reporting. If you found this lecture valuable, please consider subscribing to our channel and liking this video. Your support motivates us to continue delivering high-quality educational content. We look forward to seeing you in our next lecture, where we will delve into Chapter 2. Until then, continue to explore and engage with the material. Goodbye, and see you soon. Thank you once again for your participation. Have a great day and see you next time. Welcome back, everyone, to our lecture series. Today, we are diving into Chapter 2 of our syllabus, Qualitative Characteristics of Useful Financial Information. In this lecture, we will cover the following topics: Introduction to Qualitative Characteristics, Fundamental Qualitative Characteristics, Relevance, Materiality, Faithful Representation, Applying the Fundamental Qualitative Characteristics, Enhancing Qualitative Characteristics, Comparability, Verifiability, Timeliness, Understandability. Applying the Enhancing Qualitative Characteristics. The Cost Constraint on Useful Financial Reporting. Introduction to Chapter 2. The qualitative characteristics of useful financial information are essential for identifying the types of information that are most beneficial to investors, lenders, and other creditors. These characteristics ensure that the financial information provided is of high quality and aids in decision-making. Financial reports offer information about an entity's economic resources, claims against the entity, and the effects of transactions and events that alter those resources and claims. This is referred to as information about economic phenomena. Additionally, some financial reports include forward-looking information, such as management's expectations and strategies for the entity. These qualitative characteristics apply not only to financial statements, but also to other forms of financial information provided by the entity. The cost of providing this information is a pervasive constraint that entities must consider, balancing the benefits of the information against its cost. Information about economic phenomena. Scenario: a company's balance sheet shows a significant increase in accounts receivable. Example: this information helps users understand that the company has made more sales on credit, indicating potential future cash inflows. However, it also raises questions about the company's credit risk and how well it manages its receivables. Explanatory material and forward-looking information. Scenario: a company's financial report includes a section where management discusses future strategies and market expectations. Example: if a tech company's management discusses plans to invest in new AI technology, this forward-looking information helps investors assess the potential for future growth and profitability. However, the reliability of this information depends on the accuracy and honesty of management's expectations. Conclusion: understanding the qualitative characteristics of useful financial information is crucial for making informed decisions based on financial reports. These characteristics ensure that the information provided is relevant, faithfully represented, and useful for decision-making, while also considering the cost of providing this information. Qualitative characteristics of useful financial information. We will break down each title separately, ensuring that you understand these concepts thoroughly with detailed examples. Qualitative characteristics of useful financial information. Explanation. For financial information to be useful, it must be relevant and faithfully represent what it purports to represent. Additionally, the usefulness of financial information is enhanced if it is comparable, verifiable, timely, and understandable. These characteristics ensure that the information provided in financial reports is of high quality and can effectively assist users in making informed decisions. Fundamental qualitative characteristics. The fundamental qualitative characteristics are relevance and faithful representation. Let's break these down. Relevance. Explanation. Relevant financial information is capable of making a difference in the decisions made by users. Information can be relevant even if some users choose not to take advantage of it or are already aware of it from other sources. Financial information is relevant if it has predictive value, confirmatory value, or both. Predictive value. Information has predictive value if it can be used to predict future outcomes. This means that users can rely on this information to form expectations about the future performance or condition of the entity. Confirmatory value. Information has confirmatory value if it provides feedback about previous evaluations. This means that users can compare the information with past predictions or expectations to see if they were accurate. Example: predictive value. A company's historical revenue data can help investors predict future revenue trends. For instance, if a company has shown consistent revenue growth over the past 5 years, investors might predict continued growth. Let's say company ABC had revenues of $1 million, $1.2 million, $1.5 million, and $1.8 million in the past 4 years. Investors might use this trend to predict that next year's revenue could be around $2 million. Confirmatory value. If a company predicted its annual revenue to be $1 million and the actual revenue matches this prediction, the actual revenue data confirms the accuracy of the company's forecasting process. For example, company XYZ forecasted a revenue of $5 million for the current year, and the actual revenue came out to be $5 million, confirming that the forecasting methods used were reliable. Materiality. Explanation. Information is material if omitting, misstating, or obscuring it could reasonably be expected to influence the decisions of users. Materiality is specific to the entity and depends on the nature or magnitude of the items related to the financial report. The board cannot set a universal threshold for materiality because it varies depending on the context and the entity. Example. If a small local bakery has $1,000 in petty cash, this amount is immaterial to a decision-making process. However, if the bakery has $1 million in cash reserves, this information is material because it significantly impacts the bakery's liquidity assessment. For a large corporation like Apple, a $1 million transaction might be immaterial, but for a small business, it could be very significant. Therefore, materiality is relative and entity-specific. Faithful representation. To be useful, financial information must faithfully represent the economic phenomena it purports to represent. Faithful representation means the information is complete, neutral, and free from error. Complete. All necessary information is included for a user to understand the phenomena. This means providing a full picture without leaving out any important details. Neutral. The information is unbiased and not manipulated. It should be presented in a way that is fair and objective, without favoring any particular outcome. Free from error. There are no errors in the description or the process used to produce the information. This does not mean perfection, but rather that the information is reliable and accurate as far as can be reasonably expected. Example. Complete. If a company reports its assets, it should provide a full description, including the type of assets, their value, and how the value was determined. For example, if company ABC has a group of assets worth $10 million, it should specify what those assets are, e.g. buildings, machinery, vehicles, how they were valued, e.g. historical cost, fair value, and any other relevant information. Neutral. When reporting financial performance, a company should present all gains and losses without exaggeration or understatement. For instance, if a company incurred a loss due to a market downturn, it should report the loss honestly without trying to make it look smaller than it is. Free from error. If a company estimates the value of an asset, it should clearly state that it is an estimate and explain the method used to derive the estimate. For example, if company XYZ estimates that its inventory is worth $500,000, it should explain that this is based on the lower of cost and net realizable value method and describe how the estimate was calculated. Applying the fundamental qualitative characteristics. Explanation. For information to be useful, it must be both relevant and faithfully represented. This involves identifying an economic phenomenon, determining the most relevant information, and ensuring it provides a faithful representation. Sometimes a trade-off is necessary between relevance and faithful representation. Example. Suppose a company is estimating future cash flows from a new project. This estimate is highly relevant for investors to decide whether to invest in the company. However, there is a high level of uncertainty due to market volatility. The company should provide this estimate along with an explanation of the uncertainties involved. If the estimate is too uncertain, a less relevant but more reliably measured piece of information might be more useful. For example, If predicting future cash flows is highly uncertain, the company might instead provide historical cash flow data along with a discussion of how current market conditions might affect future cash flows. Summary. In this section, we have explored the fundamental qualitative characteristics of useful financial information: relevance, materiality, and faithful representation. These characteristics ensure that the financial information provided is useful for decision-making by being capable of making a difference, reflecting the true economic phenomena, and being complete, neutral, and free from error. Enhancing qualitative characteristics. In addition to the fundamental qualitative characteristics of relevance and faithful representation, there are several enhancing qualitative characteristics that further improve the usefulness of financial information. These are comparability, verifiability, timeliness, and understandability. Each of these characteristics plays a vital role in ensuring that financial information is as useful as possible for decision-making. Comparability. Explanation. Comparability enables users to identify and understand similarities and differences between items. This characteristic is crucial for users who need to make decisions based on comparisons, such as choosing between investing in different entities or assessing the performance of an entity over different periods. Consistency versus comparability. Consistency refers to using the same accounting methods over time or across entities. While consistency aids comparability, comparability itself requires that like items look alike and different items look different. Consistency helps achieve comparability, but it is not the same. Comparability is the broader goal that consistency helps to realize. Uniformity versus comparability. Uniformity means making unlike things look alike, which does not enhance comparability. Comparability requires truthful representations where similar items are shown similarly and dissimilar items are shown differently. Example: financial statements comparison. If Company A and Company B are in the same industry, their financial statements should use similar accounting principles to allow investors to compare their performance accurately. For instance, both companies might use the same method of depreciation for their machinery, straight line method. This allows an investor to compare their respective asset values and expenses. If Company A uses straight line depreciation and Company B uses an accelerated method, the comparison of asset values and expenses might be distorted. However, if disclosures are provided that explain the differences in methods, users can make adjustments to compare the companies more accurately. Verifiability. Explanation. Verifiability means that different knowledgeable and independent observers can reach a consensus that a particular depiction is a faithful representation. This characteristic ensures that financial information is reliable and can be trusted by users. Direct verification. Direct verification involves verifying information through direct observation. For example, counting cash to verify the cash balance reported. Indirect verification. Indirect verification involves verifying inputs and recalculating outputs using the same methodology. For instance, checking the inputs to an inventory valuation model and recalculating the ending inventory using the same cost flow assumption, e.g., FIFO, first in, first out. Example: direct verification. An auditor physically counts the cash in the company's safe to confirm the cash balance reported on the balance sheet. Indirect verification. To verify the inventory balance, an auditor checks the quantities and costs recorded in the company's system and then recalculates the inventory value using the FIFO method. If the reported inventory value matches the recalculated amount, the information is considered verifiable. Timeliness. Explanation. Timeliness means that information is available to decision makers in time to influence their decisions. Information loses its relevance if it is not available when needed. Therefore, providing information promptly is crucial for its usefulness. Timeliness versus usefulness. Generally, the older the information, the less useful it becomes. However, some information remains relevant over longer periods because it helps users identify and assess trends. Example: quarterly earnings reports. Companies typically release quarterly earnings reports shortly after the end of each quarter. These reports provide timely information about the company's financial performance, enabling investors to make informed decisions about buying, selling, or holding the company's stock. If these reports were delayed by several months, the information would be less useful for making timely investment decisions. Understandability. Explanation. Understandability means presenting information clearly and concisely so that users can comprehend it. Financial information should be classified, characterized, and presented in a way that is easy to understand for users who have a reasonable knowledge of business and economic activities. Complexity versus understandability. Some financial phenomena are inherently complex and cannot be simplified without losing essential information. While it's important to present information clearly, it is also necessary to ensure that reports are complete and not misleading. Example: clear presentation. A company's annual report includes a section that explains its financial statements and notes in plain language, avoiding technical jargon. For instance, instead of using complex financial terms, the company might explain that accounts receivable are amounts owed to the company by its customers. This makes the information more accessible to users who may not have extensive accounting knowledge. Applying the enhancing qualitative characteristics. Explanation. The enhancing qualitative characteristics should be maximized to improve the usefulness of financial information. However, they cannot make irrelevant information useful or information that does not faithfully represent what it purports to represent. Applying these characteristics is an iterative process and sometimes involves trade-offs. Iterative process. Enhancing qualitative characteristics do not follow a specific order and may require balancing. For instance, a new accounting standard might initially reduce comparability, but improve relevance and faithful representation in the long term. Trade-offs. Enhancing one characteristic might sometimes mean reducing another. Appropriate disclosures can help mitigate any negative impacts. Example: new accounting standard. A new accounting standard requiring a more detailed method of revenue recognition might initially reduce comparability with past periods or other companies that haven't yet adopted the standard. However, this new method might provide more relevant and faithfully represented information. Disclosures explaining the change and its impact can help users understand and adjust their comparisons. Conclusion. In this section, we have explored the enhancing qualitative characteristics of useful financial information: comparability, verifiability, timeliness, and understandability. These characteristics ensure that financial information is as useful as possible, aiding users in making well-informed decisions. The cost constraint on useful financial reporting. Explanation. The cost constraint on useful financial reporting acknowledges that while providing financial information is beneficial, it also incurs costs. These costs must be justified by the benefits derived from the information. The goal is to ensure that the value of the information provided outweighs the costs involved in its production and use. Here's a detailed look at the various aspects of this constraint. Types of costs and benefits. 1. Costs to providers of financial information. Collection and processing. Gathering and processing data to prepare financial statements. Verification. Costs incurred for auditing and verifying the information to ensure its accuracy. Dissemination. Costs related to distributing the financial information, such as printing reports or maintaining digital platforms. 2. Costs to users of financial information. Analysis and interpretation. Users, such as investors and analysts, spend time and resources to analyze and interpret the information provided. Additional information. If financial reports do not include all necessary information, users may incur extra costs to obtain this information from other sources or make estimates. 3. Benefits of financial reporting. Improved decision-making. Relevant and faithfully represented financial information helps users make better investment, lending, and other financial decisions. Efficient capital markets. Better information leads to more efficient markets, reducing the cost of capital. Informed decisions. Individual users, including investors and creditors, benefit from making more informed decisions, potentially leading to better returns or lower risks. Example: implementation of a new standard. Costs. A company might incur significant costs in implementing a new accounting standard that requires detailed disclosures about lease obligations. These costs could include system upgrades, additional staff training, and more comprehensive audits. Benefits. The detailed information helps investors better understand the company's financial position and future cash flow obligations, leading to more informed investment decisions and potentially a lower cost of capital for the company. Assessing costs versus benefits. When the board, such as the IASB, develops new accounting standards, it evaluates whether the benefits of the proposed information justify the associated costs. This assessment involves gathering input from various stakeholders, including 1. Providers of financial information, to understand the effort and expense involved in collecting and reporting the information. 2. Users of financial information, to gauge the value and utility of the information in decision-making. 3. Auditors and academics, to provide insights into the accuracy, reliability, and implications of the information. The assessment typically combines both quantitative and qualitative data. Quantitative assessments might include numerical cost estimates and potential economic impacts, while qualitative assessments might consider the overall usefulness and reliability of the information. Example: feedback loop. Providers. Companies might report that the cost of implementing a new reporting requirement is high due to the need for advanced data collection systems. Users. Investors might indicate that the additional information significantly enhances their ability to assess the company's future prospects and risks. Board's decision. Based on this feedback, the board might decide that the long-term benefits to investors and the market justify the initial costs to companies. Subjectivity and variability. Given the inherent subjectivity in evaluating costs and benefits, different stakeholders might have varying opinions on the same reporting requirement. To address this, the board considers the broader context of financial reporting, not just the impact on individual entities. This ensures a balanced approach that considers the needs of various users and the practical realities faced by providers. Example: differing assessments. Large public companies might find it easier to absorb the costs of new reporting requirements due to their extensive resources and sophisticated financial systems. Small private companies might find the same requirements disproportionately burdensome due to limited resources and simpler financial operations. Board's approach. The board might introduce scaled requirements where smaller entities have different, perhaps simplified reporting standards compared to larger entities, ensuring relevance and feasibility across the spectrum. Conclusion. Understanding the cost constraint on useful financial reporting helps us appreciate the balance required in financial reporting standards. It's about ensuring that the information provided is not only useful, but also economically justifiable. Chapter 2, Summary: Qualitative Characteristics of Useful Financial Information. In Chapter 2, we covered the following key points. 1. Qualitative characteristics of useful financial information. Fundamental qualitative characteristics. Relevance. Information must be capable of making a difference in user decisions, possessing predictive or confirmatory value. Faithful representation. Information must accurately depict the economic phenomena it represents, being complete, neutral, and free from error. 2. Enhancing qualitative characteristics. Comparability. Enables users to identify and understand similarities and differences between items. Verifiability. Assures users that information faithfully represents the phenomena it purports to represent through direct or indirect verification. Timeliness. Information must be available in time to influence decisions. Understandability. Information must be presented clearly and concisely, making it comprehensible to users with reasonable knowledge. 3. The cost constraint on useful financial reporting. recognizes that providing financial information incurs costs which must be justified by the benefits. Involves assessing whether the benefits of information outweigh the costs, considering input from various stakeholders. Balances the needs of different users and providers, ensuring practical and useful financial reporting. Thank you for watching. If you found this helpful, please subscribe to our channel and like the video to support us. See you in Chapter 3. Welcome everyone to today's lecture on Chapter 3 of the Conceptual Framework for Financial Reporting. Today, we will explore the key aspects of financial statements and the reporting entity. Our focus will be on 1. Financial statements, objective and scope of financial statements, reporting period, perspective adopted in financial statements, going concern assumption. 2. The reporting entity, consolidated and unconsolidated financial statements. Let's dive into each of these topics in detail, explaining them in simple terms and providing easy-to-understand examples. Financial statements, objective and scope of financial statements. The main goal of financial statements is to provide useful financial information about a company. This information helps people understand what the company owns, assets, what it owes, liabilities, the value of the owner's interest in the company, equity, the money it earns, income, and the costs it incurs, expenses. This information is important for people who want to predict the company's future cash flows, like investors or lenders, and to see how well the company's management is handling its resources. Financial information is provided through Statement of Financial Position. This shows what the company owns, what it owes, and the owner's interest at a specific point in time. Statement of Financial Performance. This shows the company's income and expenses over a period of time. Other statements and notes. These provide additional information about recognized and unrecognized assets and liabilities, cash flows, contributions from and distributions to equity holders, and the methods and assumptions used in preparing the financial statements. Example. Imagine a small bakery, Sweet Treats Bakery, which has assets like ovens, ingredients, and cash. The financial statements will show these assets, any loans the bakery owes, liabilities, the owner's investment in the bakery, equity, the revenue from selling baked goods, income, and the costs of ingredients and wages, expenses. Reporting period. Financial statements are prepared for a specific time period, usually a year or a quarter, known as the reporting period. They provide information about the company's financial position at the end of this period and its financial performance throughout the period. To help users see changes and trends, financial statements also include comparative information from at least one previous period. Example. For Sweet Treats Bakery, if the reporting period is the year 2023, the financial statements will show the bakery's financial position as of December 31st, 2023, and its financial performance throughout 2023. It will also include data from 2022 for comparison, showing how the bakery's finances have changed over time. Perspective. Adopted in financial statements. Financial statements are prepared from the perspective of the company as a whole. This means they aim to provide a complete picture of the company's financial status, not just focusing on the interests of any specific group, such as investors or creditors. Example. Sweet Treats Bakery's financial statements are prepared to reflect the overall financial health of the bakery, not just from the viewpoint of its shareholders or creditors. Going concern assumption. Financial statements are usually prepared with the assumption that the company will continue its operations into the foreseeable future. This means the company does not plan to shut down or significantly reduce its operations. Example. Sweet Treats Bakery plans to continue its business operations without any intention of closing down or selling off its assets in the near future, so its financial statements are prepared based on this assumption. The reporting entity. Consolidated and unconsolidated financial statements. A reporting entity may consist of a single entity, a part of an entity, or multiple entities. When one entity, parent, controls another, subsidiary, the financial statements can be either consolidated or unconsolidated. Consolidated financial statements. These combine the financial information of the parent and its subsidiaries as a single entity. This helps in assessing the overall financial health and net cash inflows of the entire group. Unconsolidated financial statements. These provide information about the parent entity alone without including the subsidiaries. This is useful for understanding the parent's standalone financial position and performance. Example: consolidated. If Sweet Treats Bakery owns another bakery, Delicious Delights Bakery, the consolidated financial statements will combine the financials of both bakeries, showing the total assets, liabilities, income, and expenses of the combined entity. Unconsolidated. The unconsolidated financial statements of Sweet Treats Bakery will only show its financial information without including Delicious Delights Bakery's financial data. Determining the boundary of a reporting entity. Determining what constitutes a reporting entity can be complex, especially if it's not a legal entity or includes multiple entities not linked by a parent-subsidiary relationship. The boundary is defined based on the information needs of the primary users of the financial statements, ensuring that the information provided is relevant and accurately represents the economic activities. Example: suppose Sweet Treats Bakery and another company, Yummy Bites Bakery, are jointly managed but not legally linked. The combined financial statements would need to provide clear and complete information that accurately represents the joint operations for the benefit of the users. Conclusion. Today, we discussed the objectives and scope of financial statements, the concept of the reporting period, the perspective adopted in financial statements, and the going concern assumption. We also explored the nature of reporting entities and the differences between consolidated and unconsolidated financial statements. Thank you for watching today's lecture. If you found this video helpful, please subscribe to our channel and like the video. See you in our next lecture on Chapter 4. Goodbye. Welcome, everyone, to today's lecture on Chapter 4 of the Conceptual Framework for Financial Reporting. In this lecture, we will be diving into the elements of financial statements. Here's what we will be covering. Contents of Chapter 4. 1. Introduction. 2. Definition of an asset, right, potential to produce economic benefits, control. 3. Definition of a liability, obligation, transfer of an economic resource, present obligation as a result of past events. 4. Assets and liabilities, unit of account, executory contracts, substance of contractual rights and contractual obligations. 5. Definition of equity. 6. Definitions of income and expenses. Introduction to the elements of financial statements. The elements of financial statements, as defined in the conceptual framework, are fundamental components that help in understanding a company's financial position and performance. These elements are categorized into two main groups. 1. Financial position elements. Assets, resources controlled by the entity that are expected to produce economic benefits. Liabilities, obligations of the entity to transfer economic resources to others. Equity, the residual interest in the entity's assets after deducting liabilities. 2. Financial performance elements. Income, increases in assets or decreases in liabilities that result in an increase in equity, excluding contributions from equity holders. Expenses, decreases in assets or increases in liabilities that result in a decrease in equity, excluding distributions to equity holders. These elements are interconnected with the economic resources and claims discussed in Chapter 1. Here's a brief overview of each element. Asset, a present economic resource controlled by the entity as a result of past events. An economic resource is a right that has the potential to produce economic benefits. Liability, a present obligation of the entity to transfer an economic resource as a result of past events. Equity, the residual interest in the assets of the entity after deducting all its liabilities. Income, increases in assets or decreases in liabilities that result in increases in equity other than those relating to contributions from holders of equity claims. Expenses, decreases in assets or increases in liabilities that result in decreases in equity, other than those relating to distributions to holders of equity claims. Understanding these elements is crucial for interpreting financial statements and assessing a company's financial health and performance. We'll explore each of these elements in detail in today's lecture. Let's go through the explanation in much more detail and include thorough examples for each title and subtitle to ensure clarity. Definition of an asset. An asset is a present economic resource controlled by the entity as a result of past events. This definition includes three critical components. 1. Right. 2. Potential to produce economic benefits. 3. Control. 1. Rights. Corresponding to an obligation of another party. Rights that correspond to obligations from other parties can include rights to receive cash. This often occurs in sales made on credit. Example, a retailer sells a television to a customer on credit, where the customer will pay $500 in 30 days. The retailer now holds the right to receive $500 from the customer in the future. This right is considered an asset because it will generate future economic benefits for the retailer. Rights to receive goods or services. When a company makes an advance payment, it gains the right to receive goods or services in return. Example, an airline company pays $10,000 in advance to an aircraft maintenance company for future maintenance services. The airline has the right to receive maintenance services in the future, which is an asset because it has the potential to bring economic benefits by ensuring aircraft are in good working condition. Rights to exchange economic resources on favorable terms. This can be seen in derivative contracts like forwards and options. Example, a bakery enters into a forward contract to buy wheat at $200 per ton when the market price is $250 per ton. This contract gives the bakery a favorable term to buy wheat, which is an asset because it provides the potential to save money, thus increasing economic benefits. Rights dependent on an uncertain future event. These are often contingent on specific conditions being met. Example, a construction company has an insurance policy that will pay out $1 million if their ongoing project is delayed due to natural disasters. This insurance policy is an asset because it holds the potential to generate economic benefits if the specified event, a natural disaster, occurs. Rights not corresponding to an obligation of another party. These rights exist inherently within the entity and do not depend on another party. Rights over physical objects. These include ownership or lease rights over physical items like buildings or equipment. Example, a manufacturing firm owns a piece of machinery used in production. The right to use this machinery to produce goods and generate revenue is an asset. Rights to use intellectual property. Intellectual properties like patents and trademarks fall under this category. Example, a tech company holds a patent for a unique software algorithm. The exclusive right to use this algorithm is an asset, as it can be utilized to develop software products and generate sales. Establishment of rights. Rights can be established through various means, such as contracts, legal agreements granting specific rights. Example, a company signs a lease contract for office space, giving it the right to use the office for a specified period. This lease is an asset because it grants the company the right to use the office space to conduct its operations. Legislation, government grants or regulations that provide rights. Example, a telecommunications company receives a license from the government to operate cellular networks. This license is an asset because it allows the company to provide services and generate revenue. Other means, developing proprietary knowledge or processes. Example, a pharmaceutical company develops a new drug formula that is kept as a trade secret. The exclusive right to use this formula in production is an asset. Exclusions. Not all rights qualify as assets. Public rights, rights accessible to everyone without significant cost. Example, the right to access public roads is not an asset for any company because it is available to everyone without cost. Self-issued instruments, instruments like treasury shares or own-issued debt held by the entity. Example, a company repurchases its own shares and holds them as treasury stock. These shares are not assets because they do not represent economic benefits to the company. Aggregating rights. Related rights are often treated as a single unit of account. Legal ownership of a physical object includes multiple rights related to the object. Example, owning a delivery truck includes the rights to use, sell, lease, and pledge the truck. These combined rights are accounted for as a single asset. 2. Potential to produce economic benefits. An economic resource must have the potential to produce economic benefits. This potential does not need to be certain or even likely. It just needs to exist in at least one scenario. Ways economic resources produce benefits. Economic resources can produce benefits in various ways. Receiving cash flows, regular payments such as interest or dividends. Example, a company holds a bond that pays $1,000 in interest annually. This right to receive interest payments is an asset. Exchanging resources on favorable terms, benefiting from advantageous trade conditions. Example, a company has a contract to buy raw materials at a below-market price, which allows it to save money and increase profitability. Producing goods or services, using resources to generate revenue. Example, a bakery uses its ovens to bake bread, which it sells for profit. The ovens are assets because they help in generating revenue. Selling the resource, converting the asset into cash. Example, a company sells a piece of real estate it owns for $1 million. The real estate was an asset because it could be sold for a significant amount of money. Avoiding cash outflows. Reducing expenses through ownership. Example, a company owns its office building, which means it doesn't have to pay rent. This ownership helps the company save on rental expenses, providing economic benefits. Example of low probability benefits. Even if the probability of benefits is low, as long as the potential exists, the item can still be considered an asset. Example, a biotech firm holds a patent for a drug that may not become a market success. Despite the low probability of high sales, the patent is an asset because it has the potential to generate economic benefits. Hopper 3. Control. Control means the entity has the ability to direct the use of the resource and obtain the benefits. Aspects of control. Direct use. The entity can use the resource in its operations. Example, a manufacturing company uses its factory to produce goods. The factory is an asset because the company controls and uses it to generate products. Preventing others from using it. Ensuring no one else benefits from the resource. Example, a software company with exclusive rights to a particular technology can prevent others from using it, ensuring only the company benefits from its use. Legal rights and other means. Control is often through legal rights, but can also be through other means, such as exclusive access. Example, a firm has access to proprietary technology that is not publicly known. This exclusive access means the firm controls the technology even if it is not legally protected by a patent. Control and economic benefits. For an entity to control an economic resource, the benefits must flow to the entity, either directly or indirectly. Direct benefits. Using the asset to generate revenue directly. Example, a retail store uses its inventory to make sales. The inventory is an asset because it helps generate sales revenue. Indirect benefits, enhancing other assets or operations. Example, a company uses a specialized software program to improve its production efficiency, indirectly benefiting its overall operations. Principal-agent relationship. If a principal engages an agent, the resource controlled by the principal is not an asset of the agent. Example, a retailer, principal, hires a logistics company agent to manage its inventory. The inventory remains the asset of the retailer, not the logistics company. Comprehensive example. Consider a company that owns a fleet of delivery trucks. Right. The company has legal ownership and can use, sell, or lease the trucks. Potential to produce economic benefits. The trucks help in delivering products, generating revenue. They can also be sold if needed. Control. The company decides how to use the trucks and maintains them, preventing others from using them. These trucks are assets because they are economic resources controlled by the company with the potential to produce future economic benefits. Conclusion. Understanding assets is fundamental to financial reporting and accounting. By recognizing what constitutes an asset, companies can accurately report their financial position and performance. Definition of a liability. A liability is a present obligation of the entity to transfer an economic resource as a result of past events. For a liability to exist, 3 criteria must all be satisfied. 1. The entity has an obligation. 2. The obligation is to transfer an economic resource. 3. The obligation is a present obligation that exists as a result of past events. Let's break down each of these criteria in detail, providing comprehensive examples to ensure a clear understanding. Obligation. Obligation refers to a duty or responsibility that an entity has no practical ability to avoid. This obligation is always owed to another party or parties, which could be individuals, other entities, groups, or even society at large. The identity of the party or parties to whom the obligation is owed does not necessarily have to be known. Examples of obligations. 1. Legal obligations. These are established by contracts, legislation, or similar means and are legally enforceable. For example, a company, ABC Corp., borrows $1 million from a bank. ABC Corp. Has a legal obligation to repay the loan with interest according to the terms of the loan agreement. 2. Constructive obligations. These arise from an entity's customary practices, published policies, or specific statements. For example, XYZ Limited has a policy of paying year-end bonuses to employees based on company performance. Even if not legally obligated, XYZ Limited has a constructive obligation to pay these bonuses because it has created an expectation among employees. 3. Conditional obligations. These depend on the entity taking a specific future action. For example, DEF Industries operates a factory and must clean up any environmental damage if it continues to operate in that location. The obligation to clean up is conditional on continuing operations. Transfer of an economic resource. The second criterion for a liability is that the obligation must be to transfer an economic resource. This means that the obligation must have the potential to require the entity to transfer an economic resource to another party or parties. Examples of transfer of economic resources. 1. Obligations to pay cash. A company, GHI Limited, owes $20,000 to a supplier for goods received. The obligation to pay cash to the supplier is a liability. 2. Obligations to deliver goods or provide services. A construction company, JKL Builders, has received an advance payment of $100,000 for a building project. JKL Builders has an obligation to complete the construction project. 3. Obligations to exchange economic resources on unfavorable terms. M&O Inc. has entered into a forward contract to sell oil at a price below the current market value. This obligation to sell oil at a lower price is a liability. 4. Obligations dependent on an uncertain future event. PQR Limited may have to pay damages if it loses a lawsuit. The obligation exists even if it is uncertain whether PQR Limited will lose the case. 5. Obligations to issue financial instruments. If a company, S2 Corp., has issued bonds, it has an obligation to pay interest and repay the principal amount to the bondholders. Present obligation as a result of past events. The third criterion for a liability is that the obligation must be a present obligation resulting from past events. This means that the entity must have already obtained economic benefits or taken actions that result in the obligation to transfer an economic resource in the future. Examples of present obligations. 1. Obtained economic benefits. A company, VWX Limited, has used raw materials received from a supplier. The obligation to pay for these materials is a present obligation resulting from the past event of receiving the materials. 2. Taken an action. A company, YZA Corp., has signed a lease agreement for office space. The obligation to pay rent is a present obligation resulting from the past event of signing the lease. 3. Legislation or constructive obligations. If a new law requires companies to pay for pollution control equipment, the obligation arises only when the company continues to operate in a way that causes pollution. The mere enactment of the law does not create a liability. 4. Conditional on future actions. If a company, BCD Enterprises, agrees to pay a bonus to employees based on meeting certain performance targets, the obligation exists only when the targets are met. Before that, it is a potential obligation. Comprehensive example. Example of a liability. ABC Limited manufactures electronics and sells them to retailers. ABC Limited has received a shipment of raw materials from a supplier and has agreed to pay $50,000 for these materials within 60 days. Additionally, ABC Limited has signed a contract to deliver 500 televisions to a major retailer next month and received an advance payment of $20,000. Analysis. 1. Obligation. ABC Limited has an obligation to pay $50,000 to the supplier and an obligation to deliver 500 televisions to the retailer. 2. Transfer of economic resource. The $50,000 payment to the supplier and the delivery of 500 televisions are transfers of economic resources. 3. Present obligation as a result of past events. The receipt of raw materials and the advance payment for televisions are past events that create present obligations for ABC Limited. In this scenario, ABC Limited must recognize liabilities for the $50,000 owed to the supplier and the obligation to deliver 500 televisions. These liabilities are recorded in ABC Limited's financial statements, reflecting the company's present obligations to transfer economic resources as a result of past events. Conclusion. Understanding liabilities is crucial for accurate financial reporting and decision-making. Liabilities represent obligations that can significantly impact an entity's financial health. By comprehensively analyzing and recognizing liabilities, entities can provide transparent and faithful representations of their financial positions. The detailed examples provided illustrate various types of obligations and how they manifest in real-world scenarios, aiding in a deeper understanding of this essential financial concept. Assets and liabilities. Assets are things a company owns that have value and can be used to generate money. For example, cash in the bank, buildings, and equipment are assets because they contribute to a company's ability to operate and make profits. Liabilities are what a company owes to others. This could be loans, bills that need to be paid, or promises to deliver goods or services in the future. Liabilities represent financial obligations that the company needs to fulfill. Unit of account. The unit of account is about how companies group and report their assets, liabilities, income, and expenses in financial statements. It's important because it impacts how information is presented to users of financial statements. Example. Imagine a company leases office space. Instead of reporting each lease separately, they might group all similar leases together to give a clearer picture of their total lease obligations. Executory contracts. Executory contracts are agreements where both parties still have things to do. This means neither party has completed all their obligations under the contract. Example, a contract to build a house is executory until the builder finishes and the buyer pays in full. Both parties have ongoing responsibilities until the house is completed and paid for. Substance of contractual rights and obligations. This concept focuses on the real economic impact of contracts, not just their legal form. It ensures that financial statements accurately reflect the true nature of agreements between the company and others. Example, a software subscription contract includes not just the payment terms, but also the implicit support services provided by the company. Even if not explicitly stated, these support services are crucial for the customer and affect how the company reports its revenues. Understanding these concepts helps anyone, whether they're studying business or not, to grasp how companies communicate their financial health and responsibilities to the world. It ensures transparency and helps stakeholders make informed decisions about investments or business relationships. Understanding equity in financial reporting. Definition of equity. Equity represents the ownership interest in a company. It is what remains after subtracting all liabilities from the company's assets. This residual interest belongs to the shareholders. Example, if a company's assets total $1 million and its liabilities are $400,000, the equity would be $600,000. Types of equity claims. Share 1. Shares. Shares represent ownership in the company and can be of different types. Ordinary shares. These typically carry voting rights and a residual claim on assets after all other claims have been met. Example, owning ordinary shares in a tech company gives you a claim to part of its profits and a vote in major decisions. Preference shares. These often have priority in receiving dividends before ordinary shareholders, but may have limited or no voting rights. Example, preference shareholders might receive a fixed 5% dividend on their shares before any dividends are paid to ordinary shareholders. 2. Obligations to issue equity. Sometimes, companies have commitments to issue more shares in the future, such as through stock options or convertible bonds. Example, if a company has issued stock options to employees, these options, when exercised, will convert into shares, increasing the equity claims against the company. Different classes of equity. 1. Dividend rights. Shareholders may have the right to receive dividends if the company decides to distribute profits. Example, preference shareholders might receive a 5% dividend on their shares before any dividends are paid to ordinary shareholders. 2. Liquidation rights. In the event of company liquidation, different classes of shareholders have different rights to the remaining assets. Example, if a company goes bankrupt and is liquidated, preference shareholders are paid from the remaining assets before ordinary shareholders. Legal and regulatory aspects. Legal and regulatory requirements can affect how equity is managed and reported. 1. Distribution restrictions. Regulations often require companies to have sufficient distributable reserves before they can pay dividends. Example, a company might need to retain a certain portion of its earnings as reserves, which cannot be distributed as dividends to ensure it can meet future liabilities. 2. Share capital and retained earnings. Companies must adhere to legal requirements regarding the management of share capital and retained earnings. Example, legal regulations may mandate that a company maintain a minimum level of share capital and restrict the use of retained earnings for dividend payments unless certain financial conditions are met. Equity across different entities. The concept of equity applies to various types of business entities. Tranche 1. Sole proprietorships. In a sole proprietorship, the owner's equity is the residual interest in the assets of the business after deducting liabilities. Example, a sole proprietor can withdraw profits from the business at any time without legal restrictions. 2. Partnerships. In partnerships, partners share the residual interest in the assets of the business according to their partnership agreement. Example, in a partnership, profits are distributed according to the partnership agreement, which might specify that one partner receives 60% of the profits and the other 40%. 3. Trusts and government business undertakings. These entities have unique legal and regulatory frameworks, but the principle of equity as the residual interest remains applicable. Example, in a trust, equity might be distributed to beneficiaries according to the terms of the trust deed, while government business undertakings may have specific rules for the distribution of surplus funds. Comprehensive example. Imagine a technology startup, Tech Innovate, which has the following financial structure. Assets, $1 million. Liabilities, $400,000. Equity, $600,000, calculated as $1 million, $400,000. Tech Innovate has issued different types of shares. 1. Ordinary shares. These give shareholders voting rights and a claim on residual profits after all obligations are met. Example. Shareholders holding ordinary shares can vote on major company decisions and receive dividends from the remaining profits after preference shareholders are paid. 2. Preference shares. These shareholders receive fixed dividends and have priority over ordinary shareholders in case of liquidation, but usually do not have voting rights. Example, preference shareholders receive a fixed 6% dividend annually before any dividends are distributed to ordinary shareholders. In case TechInnovate is liquidated, preference shareholders will be paid from remaining assets before ordinary shareholders receive any proceeds. TechInnovate is also subject to regulatory requirements that restrict dividend payments unless the company has sufficient retained earnings. Legal restriction example. TechInnovate can only distribute dividends if it has sufficient retained earnings specified by regulatory requirements. By understanding these principles, stakeholders can better interpret a company's financial health and the implications of its equity structure. This understanding helps in making informed decisions about investments and assessing the company's financial stability and growth potential. Understanding income and expenses in financial reporting. Definitions of income and expenses. Income refers to increases in assets or decreases in liabilities that result in a boost to equity, excluding contributions from equity holders. Example, when a company sells products or provides services, it earns revenue, which increases its assets like cash and equity, profits. Expenses are decreases in assets or increases in liabilities that lead to a reduction in equity, excluding distributions to equity holders. Example, paying salaries or purchasing supplies are expenses because they decrease assets, cash, and reduce equity, profits. Key points. 1. Impact on equity. Income and expenses directly impact a company's equity by either increasing or decreasing it based on their nature. 2. Exclusion of equity contributions and distributions. Contributions from equity holders, like issuing new shares, are not considered income. Similarly, distributions to equity holders, like dividends, are not expenses. 3. Financial performance indicators. Income and expenses are critical components of financial statements that reflect an entity's financial performance. 4. Different characteristics. Various transactions generate income and expenses with distinct attributes. Reporting them separately helps stakeholders understand an entity's financial performance more accurately. Importance in financial reporting. Comprehensive insight. While assets and liabilities showcase a company's financial position, income and expenses reveal its financial performance over a period. Decision-making. Investors and creditors rely on income and expense information to assess profitability, operational efficiency, and sustainability. Transparency. Providing clear and detailed information about income and expenses enhances transparency in financial reporting, fostering trust among stakeholders. By understanding income and expenses, stakeholders gain insights into how a company generates revenue, manages costs, and ultimately impacts its financial health. This knowledge aids in making informed investment decisions and evaluating a company's overall financial well-being. Conclusion on elements of financial statements. In conclusion, the elements of financial statements, assets, liabilities, equity, income, and expenses are fundamental pillars that collectively depict the financial position and performance of an entity. Each element serves a crucial role in financial reporting, providing stakeholders with comprehensive insights into a company's operations and financial health. Importance of elements. Assets and liabilities. These reflect what the company owns and owes, forming the basis of its financial position. Equity represents the residual interest in assets after deducting liabilities, indicating ownership interests. Income and expenses showcase the financial performance by detailing revenue generation and costs incurred over a period. Significance in decision-making. Understanding these elements empowers investors, creditors, and other stakeholders to make informed decisions. They use financial statements to assess profitability, operational efficiency, and the overall viability of an entity. Transparency and trust. Clear and accurate reporting of these elements ensures transparency in financial disclosures, building trust with stakeholders. It enables comparisons across periods and with other entities, facilitating robust financial analysis. Looking ahead, As we conclude Chapter 4 on the elements of financial statements, I encourage you to subscribe and like our channel to stay updated. In our next lecture on Chapter 5, we will delve into the conceptual framework's recognition and derecognition principles. Understanding these concepts will further enhance your grasp of how transactions and events are recognized in financial statements. Thank you for joining today's lecture. I look forward to seeing you in Chapter 5 as we explore more insights into the conceptual framework of financial reporting. Welcome back, students. I hope you're all ready to dive into Chapter 5 of the Conceptual Framework for Financial Reporting. In this chapter, we will be covering the important topics of recognition and derecognition. Here's what we will explore. 1. The recognition process. Understanding how and when items should be recognized in the financial statements. 2. Recognition criteria. Relevance. Ensuring the information provided is useful for decision-making. Existence uncertainty. Handling situations where there's uncertainty about the existence of an item. Low probability of an inflow or outflow of economic benefits. Dealing with items that have a low chance of resulting in economic benefits. Faithful representation. Ensuring that recognized items accurately reflect the economic phenomena they represent. Measurement uncertainty. Addressing issues related to the accuracy of the measurement of recognized items. Other factors, considering additional elements that may affect recognition. 3. Derecognition, understanding when and how to remove items from the financial statements. The content of this chapter is very important, and we will explain each subject in detail, providing examples to ensure that everyone understands it. Let's get started and make sure we grasp these essential concepts thoroughly. Overview of the recognition process. The recognition process in accounting ensures that items are correctly included in financial statements. This involves checking if the item fits the definition of a financial element, determining if it will likely bring future benefits or costs, ensuring its value can be measured accurately, and then recording it properly in the financial statements. Steps in the recognition process. 1. Definition. Check if the item is an asset, liability, income, or expense. Example, an asset is something valuable that the business owns, like equipment or cash. A liability is something the business owes, like a loan. 2. Probability of future economic benefits. See if it's likely that the item will bring in or cost the business money in the future. Example, for an asset, this means it will likely help the business make money. For a liability, this means the business will probably have to pay money. 3. Reliable measurement. Make sure you can accurately figure out how much the item is worth. Example, this means you should be able to use invoices, market prices, or other evidence to prove the item's value. 4. Criteria satisfaction. Confirm that both the probability of future benefits or costs and reliable measurement are met. Example, both these checks need to be satisfied before the item can be recorded in the financial statements. 5. Initial recognition. Record the item in the financial statements at its initial cost or value. Example, when you first record the item, use its purchase price or fair value. For example, if you buy a computer for the business, record it at the purchase price. 6. Subsequent measurement. Update the item's value in future financial statements. Example, over time, adjust the item's value as needed. For example, reduce the value of a piece of equipment as it gets older, depreciation, or adjust the value of inventory if it loses value. By following these steps, you can ensure that your financial statements are accurate and provide useful information for decision-making. Purpose of financial statements. Explanation. Financial statements summarize an entity's recognized financial items in a structured way, making them easy to understand and compare. The amounts included in these summaries form totals and subtotals, linking related items. Example. A balance sheet shows all the company's assets and liabilities, allowing stakeholders to see the total equity and assess the company's financial health. Linking elements. Explanation. The balance sheet and income statement are connected. Total assets minus total liabilities equal total equity. Changes in equity include income minus expenses, contributions from and distributions to shareholders. Example, if a company earns $10,000 in revenue, income, and has $7,000 in expenses, the net income of $3,000 increases the equity on the balance sheet. Interconnected recognitions. Explanation. Recognizing one item often affects others. For example, recognizing income might mean recognizing a new asset or reducing a liability. Recognizing expenses might mean recognizing a new liability or reducing an asset. Example, when a company provides a service and earns revenue, it recognizes income. This might also increase the cash asset if the customer pays immediately. Simultaneous income and expense recognition. Explanation. Sometimes, recognizing new assets or liabilities leads to recognizing both income and expenses at the same time, like when selling goods for cash. This matching of costs with income happens naturally, but is not the main goal. Items must meet specific definitions to be recognized. Example, when a store sells inventory for cash, it recognizes income from the cash received and an expense for the cost of the inventory sold, matching the income and expense in the financial statements. In short, the recognition process ensures that financial statements accurately reflect an entity's financial position and performance by including items that meet specific criteria. Let's go through the recognition criteria in detail, ensuring we capture all the essential points. Overview. Recognition in financial reporting involves determining whether an item meets the definition of an asset, liability, equity, income, or expense, and whether it satisfies specific criteria. Recognition is crucial as it ensures that financial statements provide relevant and reliable information to users. The main considerations for recognition include relevance, existence uncertainty, the probability of inflow or outflow of economic benefits, faithful representation, measurement uncertainty, and other factors. Hash subtitles explained. 1. Relevance. Information about assets, liabilities, equity, income, and expenses is considered relevant if it can influence the economic decisions of users. However, simply meeting the definition of an asset or liability does not automatically imply that recognizing it will provide relevant information. Example, if it's uncertain whether an asset exists or the probability of an inflow or outflow is low, its recognition might not be relevant. For instance, a potential future lawsuit with a very low probability of resulting in a liability might not be relevant to recognize immediately. 2. Existence uncertainty. Sometimes, it's uncertain whether an asset or liability exists. This uncertainty can be due to legal disputes, regulatory approvals, or other conditions. In such cases, the recognition of the item depends on the likelihood of its existence. Example, if a company is involved in a legal dispute over a patent, the uncertainty about whether the company will retain the patent, an asset, might prevent its recognition until the dispute is resolved. 3. Low probability of an inflow or outflow of economic benefits. Even if an asset or liability exists, if the probability of an inflow or outflow of economic benefits is low, recognizing the item might not provide useful information. Information about the magnitude and timing of possible inflows or outflows might be more relevant. Example, a company may have a contingent liability from a lawsuit. If the likelihood of losing the case, and therefore having to pay, is very low, it might not recognize the liability, but instead provide information about the potential outcome in the notes. 4. Faithful representation. Recognition should provide a faithful representation of the item, meaning it should be complete, neutral, and free from material error. This includes ensuring that the depiction of the asset or liability is accurate. Example, if a company sells a piece of equipment but retains significant control over its use, recognizing the sale might not faithfully represent the transaction. The company might need to continue recognizing the asset or provide explanatory information. 5. Measurement uncertainty. High measurement uncertainty can affect the decision to recognize an asset or liability. If the measure is subject to significant uncertainty, it might not provide a faithful representation. Example: estimating the future cash flows of a highly speculative investment might have such high uncertainty that recognizing the asset could mislead users. Instead, providing detailed notes might be more appropriate. 6. Other factors. Other factors influencing recognition include cost constraints and the need for explanatory information. The benefits of recognizing an item should justify the costs involved in measuring and reporting it. Example: if the cost of measuring a particular asset is prohibitively high compared to the benefit of the information it provides, the entity might decide not to recognize the asset. Conclusion: recognition in financial statements involves ensuring that only relevant, faithfully represented, and accurately measured items are included. This requires careful consideration of relevance, existence uncertainty, probability of economic benefits, faithful representation, measurement uncertainty, and other factors. By adhering to these criteria, entities can ensure their financial statements provide useful and reliable information to users. Derecognition is the process of removing an asset or a liability from a company's financial statements. This usually happens when the company no longer controls the asset or is no longer obligated to pay the liability. When does derecognition happen? Derecognition typically occurs under these circumstances. For an asset, it is derecognized when the company loses control over it. For a liability, it is derecognized when the company no longer has an obligation to pay it. Accounting requirements for derecognition. The goal is to accurately show any assets and liabilities the company still holds after the transaction, how the transaction has changed the company's assets and liabilities. Steps in the derecognition process. Remove expired assets or liabilities. Derecognize any assets or liabilities that are no longer valid, and record any resulting income or expenses. For instance, if a company pays off a loan, it should remove that liability from its financial statements. Continue recognizing retained assets or liabilities. Any parts of the assets or liabilities that are still held by the company must be recognized separately. For example, if a company sells a building but retains the right to use part of it, the retained part should still be recorded. Presentation and explanation. Clearly present and explain any remaining or removed parts in the financial statements to ensure transparency and accuracy. Special situations. Retained control. Sometimes a company might appear to transfer an asset but still controls it due to significant risks or rewards associated with it. For example, if a company sells a machine but still benefits from its use and bears the risks of its loss, it should not derecognize the machine. Agent situations. If a company transfers an asset to someone who holds it on behalf of the company still controls the asset and should not derecognize it. An example is transferring inventory to a sales agent. The company still owns the inventory until it is sold. Challenges in derecognition. Misleading financial changes. Derecognition should not misrepresent the financial position of the company. For instance, if a company sells an asset but retains an obligation to buy it back, removing the asset from the records may not fully represent the situation. If the company still faces significant risks associated with the asset, it might need to continue recognizing it. For example, if a company sells a receivable but guarantees it will be paid, it still bears significant risk and should evaluate whether to derecognize the receivable. When removing is not enough, keep recognizing the asset or liability. In some cases, the company should continue to recognize the transferred part to avoid misleading financial statements. For instance, if a company sells a piece of equipment but still uses it under a lease, it might need to keep recognizing the equipment. Treat proceeds as loans. Money received or paid during the transfer might need to be treated as a loan rather than as income or expense. For example, if a company sells inventory but has an agreement to buy it back, the proceeds might be considered a loan. Contract modifications. When a contract is changed, consider: Removing rights or obligations. Follow derecognition steps if the change removes existing rights or obligations. For instance, if a company modifies a loan agreement to eliminate some payment obligations, it should derecognize those obligations. Adding new rights or obligations. Decide if the new parts are separate or part of the existing ones. For example, adding new payment terms to a contract might require recognizing new liabilities. Extensive modifications. If the contract changes significantly, it might be necessary to treat the change as creating new assets or liabilities and derecognize the old ones. For example, if a lease contract is modified to change the leased asset, the company might need to recognize a new lease asset and liability. Complex transactions. Some transactions involve multiple components and need careful evaluation for derecognition. Example: selling a receivable, but providing a guarantee involves checking if control of the receivable is truly transferred, the extent of risk retained by the guarantee, how the transaction impacts the financial position. Steps: assess control over the asset to determine if it should be derecognized. Consider retained risks to ensure that financial statements accurately reflect the company's exposure. Ensure accurate financial representation by providing necessary explanations and presentations in the financial statements. By following these simplified steps, companies can ensure that they accurately reflect their financial situation when removing assets and liabilities from their balance sheets. Summary of Chapter 5, Recognition and Derecognition in Financial Reporting. Overview. Chapter 5 of the Conceptual Framework for Financial Reporting provides guidance on the recognition and derecognition of elements in financial statements. This ensures that the financial information presented is relevant, faithfully represented, and useful to users. The recognition process. Definition. Recognition involves including items in the Statement of Financial Position or the Statement S of Financial Performance if they meet the definitions of assets, liabilities, equity, income, or expenses. Items are depicted in these statements in words and monetary amounts, contributing to the totals of those statements. The recognized amount of an asset, liability, or equity is known as its carrying amount. Linking statements. The Statement of Financial Position and Statements of Financial Performance depict recognized items in structured summaries, enhancing comparability and understandability. These summaries link the elements of financial statements. For example, changes in equity during a reporting period reflect the income and expenses recognized in the Statements of Financial Performance. Simultaneous recognition. Recognition of one item often necessitates the recognition or derecognition of another. For instance, recognizing income may involve recognizing an asset or derecognizing a liability, while recognizing expenses may involve recognizing a liability or derecognizing an asset. Recognition criteria. Meeting definitions. Only items that meet the definitions of assets, liabilities, equity, income, or expenses are recognized. Recognition must provide useful information that is relevant and faithfully represented. Relevance and faithful representation. Recognition provides relevant information if it offers insights into an entity's financial position and performance. Faithful representation requires accurate depiction of recognized items, even if they involve estimation. Cost constraint. The benefits of recognizing an item should outweigh the costs. Judgment is necessary to determine when recognition is appropriate, considering the item's nature and circumstances. Relevance. Useful information. Information about assets, liabilities, equity, income, and expenses must be relevant to users. Recognition might not provide relevant information if there's uncertainty about the existence of an asset or liability, or if the probability of economic benefits is low. Existence uncertainty and low probability. Uncertainty or low probability of inflows/outflows doesn't automatically negate relevance. Additional explanatory information might be needed. Faithful representation. Measurement uncertainty. Estimates are essential, but must be clearly described and explained. High measurement uncertainty might affect the faithful representation of items. Sometimes, information accompanying uncertain measures can provide a more faithful representation than the measure itself. Other factors. Faithful representation also involves considering related assets and liabilities, presentation, and disclosure. Derecognition. Definition. Derecognition involves removing an asset or liability from the statement of financial position when it no longer meets the definition of an asset or liability. For assets, this usually occurs when control is lost. For liabilities, it occurs when the obligation no longer exists. Achieving aims. Derecognition should faithfully represent the change in the entity's assets and liabilities. Procedures may involve separating retained components, presenting changes in performance, or providing explanatory information. Complex transactions. If derecognition implies significant changes, other methods might be necessary to faithfully represent the entity's financial position. Conclusion. Chapter 5 elaborates on the principles of recognizing and de-recognizing elements in financial statements to ensure that they present relevant, faithfully represented, and useful information. Accurate application of these principles supports the reliability and transparency of financial reporting. Thank you for watching this lecture on Chapter 5. I hope you found it informative and clear. Don't forget to subscribe and like the video. And I look forward to seeing you in Chapter 6. Welcome to Chapter 6, Measurement. Welcome, students. In this chapter, we will explore the concept of measurement within financial reporting, one of the most important topics in the conceptual framework. Our aim is to help you understand the various measurement bases and the factors to consider when selecting a measurement basis for assets, liabilities, and equity. The first topic that we are going to cover is an introduction to Chapter 6. After that, we are going to talk about measurement bases. Under measurement bases, we are going to discuss historical cost, current value, and under current value, we will cover fair value, value in use and fulfillment value, current cost. Then we go to our third topic, which is information provided by particular measurement bases. Under this topic, we're going to talk about historical cost, current value, and under current value, we again discuss fair value, value in use and fulfillment value, current cost. Our fourth topic is factors to consider when selecting a measurement basis. Under this topic, we will cover relevance, which includes characteristics of the asset or liability, contribution to future cash flows, faithful representation, enhancing qualitative characteristics and the cost constraint, historical cost, current value, factors specific to initial measurement, more than one measurement basis. The next topic is measurement of equity. Finally, we will discuss cash flow-based measurement techniques. We will provide clear explanations and examples for each topic to make the concepts easier to understand. Let's dive into the details. Introduction. Quantifying elements in financial statements. Elements recognized in financial statements, such as assets and liabilities, need to be quantified in monetary terms. This requires selecting a measurement basis, which is an identified feature, like historical cost, fair value, or fulfillment value of the item being measured. Applying a measurement basis to an asset or liability creates a measure for that asset or liability and for the related income and expenses. Consideration of qualitative characteristics and cost constraint. When selecting measurement bases, it's important to consider the qualitative characteristics of useful financial information and the cost constraint. This means different measurement bases may be chosen for different assets, liabilities, income, and expenses to provide the most useful and relevant information. Implementation of measurement basis in standards. Sometimes, a standard may need to describe how to implement the chosen measurement basis. This description could include specifying techniques that may or must be used to estimate a measure applying a particular measurement basis, specifying a simplified measurement approach that is likely to provide information similar to that provided by a preferred measurement basis, explaining how to modify a measurement basis. For example, by excluding from the fulfillment value of a liability the effect of the possibility that the entity may fail to fulfill that liability, own credit risk. In this topic, we've covered the importance of selecting appropriate measurement bases and the factors influencing these choices. Next, we will explore different measurement bases and their implications in financial reporting. In the next section, we will discuss measurement bases in detail, including historical cost and current value, and their subtopics. Measurement bases, historical cost. Overview. In this section, we will discuss the historical cost as a measurement basis. Historical cost measures provide monetary information about assets, liabilities, and related income and expenses based on the price of the transaction or event that created them. This approach does not reflect changes in values over time, except in cases of asset impairment or liabilities becoming onerous. Understanding historical cost. 1. Definition and application. Description. Historical cost is determined by the costs incurred in acquiring or creating an asset, which includes the consideration paid and any transaction costs. For liabilities, historical cost is the consideration received minus transaction costs. This method maintains the original transaction price, ensuring that financial statements are based on actual costs rather than fluctuating market values. For example, if a company buys a machine for $10,000 and pays $500 in transaction costs, the historical cost of the machine is $10,500. This amount will be recorded in the financial statements and used as the basis for future measurements related to the machine. 2. Non-transaction events. Description. Sometimes an asset or liability may arise from events that are not market transactions, making it difficult to determine a cost. In such cases, a current value is used as a deemed cost at initial recognition, which then serves as the starting point for historical cost measurement. This ensures that the asset or liability is initially recognized at a value that reflects its current worth. Example. If a company receives a donated piece of equipment with no clear transaction price, it might use the equipment's current market value as the deemed cost. If the equipment's current value is $8,000, this amount will be used as the starting point for historical cost measurement. 3. Updating historical cost. Description. The historical cost of an asset or liability is adjusted over time to reflect several factors. Consumption, depreciation or amortization. Over time, assets such as machinery or patents lose value as they are used. Depreciation, for tangible assets, or amortization, for intangible assets, allocates the cost of the asset over its useful life. Example. If the machine bought for $10,500 is expected to last for 10 years, the company might depreciate it by $1,050 per year. This annual depreciation reduces the machine's book value and reflects its decreasing usefulness over time. Payments received. Any payments received that reduce the asset's value. Example, if a company has accounts receivable, money owed to it, and it receives partial payments, these payments reduce the value of the accounts receivable. For instance, if the company is owed $5,000 and receives $2,000, the accounts receivable balance will be reduced to $3,000. Impairment. Events that make the historical cost of the asset no longer recoverable, such as damage or obsolescence, require impairment adjustments. This ensures that the asset's recorded value does not exceed its recoverable amount. Example. If the $10,500 machine is damaged and its value drops to $6,000, the company must recognize an impairment loss of $4,500, reducing the machine's book value to $6,000. Interest accrual. Any financing components associated with the asset, such as interest on a loan used to purchase the asset, are also considered in historical cost. Example, if the company financed the machine purchase with a loan that incurs $200 in interest annually, this interest cost will be added to the asset's value, adjusting the book value accordingly. Liabilities. The historical cost of a liability is updated to reflect fulfillment, payments or actions that reduce the liability, such as making payments to settle the obligation. Example: if a company owes $1,000 to a supplier and pays $400, the liability is reduced to $600. Onerous liabilities. Events that increase the obligation to such an extent that the liability becomes onerous. This ensures that the liability reflects the true extent of the entity's obligation. Example: if new regulations increase the cost of fulfilling an environmental obligation from $5,000 to $7,000, the liability is adjusted to reflect this higher cost. Interest accrual. Any financing components associated with the liability, such as interest on borrowed funds, are also considered. Example: if a company takes out a loan with an annual interest of $300, this interest will be accrued and added to the liability. 4. Example: amortized cost. Description. One way to apply historical cost to financial assets and liabilities is through amortized cost. This method involves estimating future cash flows and discounting them at a rate determined at initial recognition. The discount rate for variable rate instruments is updated to reflect changes. Over time, the value is adjusted to reflect interest accrual, impairment, and payments received or made. Example: if a company issues a bond with a face value of $1,000 and receives $950 after transaction costs, the historical cost is $950. Over time, the company will adjust this value to account for interest payments and any changes in the bond's value due to market conditions. If the bond pays $50 in annual interest, the company will recognize this interest income, adjusting the bond's carrying amount. In summary, historical cost is a straightforward measurement basis that provides stability and reliability by reflecting the original transaction prices, with necessary adjustments over time for consumption, impairment, and financing components. This method ensures that financial statements provide a consistent and understandable picture of an entity's financial position. Measurement bases, current value overview. Current value measurement bases provide updated monetary information about assets, liabilities, and related income and expenses. Unlike historical costs, current values reflect changes in estimates of cash flows and other factors at the measurement date. Current value measurement bases include fair value, value in use, fulfillment value, and current cost. Current value. 1. Fair value. Description: fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. This value reflects the perspectives and assumptions of market participants. Essentially, it's what you'd get if you sold the asset or paid to settle the liability today, considering what people in the market would pay or require in return. Example: imagine you own a piece of land. To find its fair value, you look at similar pieces of land being sold in the current market. If similar plots are selling for $100,000, then the fair value of your land would also be around $100,000. This is because that's the price others in the market are willing to pay for such land. Determination. Fair value can be determined directly by observing prices in an active market where similar items are regularly bought and sold. When such direct observations aren't possible, fair value is estimated using techniques that consider factors such as future cash flows from the asset, time value of money, meaning how much future money is worth today, the risk of those cash flows not being realized, and any other relevant factors like liquidity or market conditions. Practical scenario. Let's say your company owns a piece of machinery that can't be sold in a ready market. To determine its fair value, you estimate the future cash flows it will generate, adjust for the uncertainty of those cash flows, and apply a discount rate to calculate their present value. This gives you the machinery's fair value. 2. Value in use and fulfillment value. Value in use. Description. Value in use is the present value of the cash flows or other economic benefits that an entity expects to derive from the use of an asset and from its ultimate disposal. It reflects the entity's own expectations and plans for the asset rather than the market's perspective. Example: suppose a company owns a factory. The value in use would be calculated by estimating the future cash flows the company expects to generate from operating the factory and then selling it at the end of its useful life. If the company expects to make $1 million a year for 10 years and sell the factory for $500,000 at the end, the present value of these amounts, discounted at an appropriate rate, represents the factory's value in use. Fulfillment value. Description: fulfillment value is the present value of the cash or other economic resources that an entity expects to transfer to fulfill a liability. This measure includes all the costs the entity expects to incur to settle the obligation. Example: imagine a company has a legal obligation to pay $50,000 to settle a lawsuit in 5 years. The fulfillment value would be the present value of that $50,000, considering the time value of money and the company's cost of funds. If the company expects to incur additional costs of $10,000 to settle the case, those costs are also included in the fulfillment value. Entity-specific assumptions. These measurements use the entity's own assumptions rather than market participants' assumptions. This means that the entity considers its own plans and expectations for cash flows from using an asset or fulfilling a liability. Practical scenario: a company plans to operate a piece of equipment for 5 years, expecting annual maintenance costs of $20,000. The value in use is calculated by estimating the present value of these costs and the expected cash inflows from using the equipment. If the company's discount rate is 5%, these future costs and cash inflows are discounted back to their present value to determine the equipment's value in use. 3. Current cost. Description: current cost is the cost of an equivalent asset or liability at the measurement date. For an asset, this means the amount you would pay today to acquire the same asset, including transaction costs. For a liability, it's the amount you would receive today to assume the same liability, minus any transaction costs. Example: if a company needs to replace an old delivery truck, the current cost would be the amount the company would pay today to buy a similar new truck. If a new truck costs $30,000, including $2,000 in transaction costs, the current cost of the truck is $32,000. Determination: sometimes, current cost cannot be observed directly and must be estimated. For example, if prices are available only for new assets, the current cost of a used asset might be estimated by adjusting the new asset's price for age, condition, and any other relevant factors. Practical scenario: if a company's existing equipment is 5 years old and a new piece of the same equipment costs $50,000, the current cost might be estimated by reducing the new equipment's price to reflect 5 years of depreciation and wear and tear. If the depreciation rate is 10% per year, the current cost of the old equipment might be around $25,000, assuming straight-line depreciation. Summary: current value measurements provide a dynamic view of an entity's financial position by reflecting the latest market conditions and expectations. These measurements are crucial for providing relevant and timely financial information, helping stakeholders make informed decisions. By understanding fair value, value in use, fulfillment value, and current cost, you can better grasp how assets and liabilities are valued in a way that reflects their true economic impact on an entity at any given time. Information provided by specific measurement bases. This section of the conceptual framework is focused on understanding what kind of information each measurement basis gives and why this information is useful for users of financial statements. Let's break down each subtitle with detailed explanations and examples. Historical cost. Relevance to users. Information about historical cost is relevant because it tells users how much was originally paid for an asset or the original amount received for a liability. This helps users understand the initial investment and can be used to track the usage and value of these items over time. Example: a company buys a machine for $50,000. This amount is recorded as the historical cost. Over time, the machine is used and its value is depreciated. After 5 years, the book value might be $30,000. This historical cost and depreciation tell users how much of the machine's value has been consumed and what is left. Predictive and confirmatory value. Historical cost helps predict future costs and margins by providing a basis for comparison. It also confirms past predictions and decisions about resource allocation. Example, if a company plans to replace the machine every 5 years, the historical cost information helps in predicting the timing and amount of future expenditures for new machines. Fair value. Market participants' expectations. Fair value provides information about the current price at which an asset can be sold or a liability can be transferred, reflecting market participants' expectations about future cash flows. Example, if the machine bought for $50,000 is now worth $40,000 in the market, the fair value of $40,000 provides a realistic and current estimate of the machine's worth, which can guide selling decisions. Predictive and confirmatory value. Fair value is useful for predicting future cash flows based on current market trends. It also provides feedback on previous valuations. Example, if the fair value of the machine decreases from $50,000 to $40,000, it might indicate declining market demand, prompting the company to reevaluate its investment in similar assets. Value in use and fulfillment. Value entity-specific information. Value in use and fulfillment value provide information based on the entity's own expectations. Value in use is the present value of future cash flows from using an asset, while fulfillment value is the present value of cash flows needed to settle a liability. Example, value in use. A company holds a patent expected to generate $60,000 in future cash flows. The value in use of the patent is $60,000, giving a realistic estimate of its economic benefit to the company. Example, fulfillment value. If a company expects to pay $70,000 to settle a legal liability, the fulfillment value of the liability is $70,000, providing a clear estimate of the future cash outflow required. Predictive and confirmatory value. These measures help in planning for future economic benefits and obligations. They also confirm the entity's assumptions about future cash flows. Example, value in use. The company can plan for the $60,000 expected from the patent, helping to forecast future revenue. Example, fulfillment value. Knowing the fulfillment value of $70,000 for a legal liability helps the company prepare for future cash outflows, ensuring adequate financial planning. Current cost, replacement or settlement cost. Current cost provides information about how much it would cost to replace an asset or settle a liability at the current date. Example, if replacing the machine today costs $55,000, this current cost tells the company how much it would need to spend to maintain its operations at current levels. Predictive and confirmatory value. Current cost helps in planning future expenditures by providing up-to-date cost information. It also confirms the cost of maintaining current operations. Example, knowing that replacing the machine costs $55,000 helps the company plan for future capital expenditures and ensures that it sets aside enough funds to replace the machine when necessary. Understanding the similarity in titles and avoiding confusion. Dear students, I understand that the similarity in titles between the sections on measurement bases and information provided by specific measurement bases might confuse you. However, it's important to grasp the distinction between these two sections to avoid any misunderstanding. Let's clarify this. 1. Measurement bases. Purpose. This section explains the theoretical foundation and calculation methods for each measurement basis. It tells you how assets and liabilities are measured. Focus. It focuses on defining the measurement bases like historical cost, fair value, value in use, fulfillment value, and current cost. Example. It explains concepts such as fair value, the price to sell an asset or transfer a liability at a certain date, and value in use, present value of future cash flows from using an asset. Example. Fair value is defined as the price that would be received to sell an asset in an orderly transaction between market participants at the measurement date. 2. Information provided by specific measurement bases. Purpose. This section explains the practical implications of these measurement bases and how the information they provide is useful to users of financial statements. It tells you what kind of information each basis provides and why it's important. Focus. It focuses on how these measurement bases help in financial decision-making, forecasting, and performance assessment. Example. It discusses how fair value provides predictive value because it reflects current market expectations and how this information can help in making informed decisions. Example. Information provided by fair value reflects market participants' current expectations about future cash flows, helping in predicting future financial performance. Key differences and how not to be confused. Theoretical versus practical. The measurement bases section is about the theory and calculation methods, whereas the information provided by specific measurement bases section is about the practical usefulness and implications of these measures. How versus what and why. Think of measurement bases as answering the question, how do we measure? And information provided by specific measurement bases as answering the questions, what does this measurement tell us? And why is this information useful? Examples in context. When learning about fair value in measurement bases, focus on understanding it as a concept, how it is calculated. When learning about fair value in information provided by specific measurement bases, focus on understanding its utility, what information it provides, and why it's valuable for decision-making. By recognizing these distinctions, you can avoid confusion and better understand the comprehensive role of measurement bases in financial reporting. Remember, the key is to see how the theory translates into practical, useful information for users of financial statements. Factors to consider when selecting a measurement basis. 1. Relevance. Characteristics of the asset or liability. The measurement basis should align with the specific characteristics of the asset or liability being valued. For example, assets like land or buildings, which are typically held for long periods and have stable values, might be more suitably measured using historical cost due to its simplicity and reliability over time. Contribution to future cash flows. It's crucial to consider how the asset or liability contributes to the company's future cash flows. Assets generating revenue over time, such as intellectual property or long-term investments, may benefit from a measurement basis that reflects their expected future economic benefits, such as discounted cash flows or fair value based on expected market performance. 2. Faithful representation. This principle emphasizes the importance of accurately portraying the economic reality of transactions. The selected measurement basis should faithfully represent the financial position, performance, and changes in financial position of the entity, providing a true and fair view without distortion or bias. 3. Enhancing qualitative characteristics and the cost constraint. Historical cost. This basis records assets at their original cost at the time of acquisition. It provides a verifiable and reliable basis, particularly when market values are volatile or unavailable. Historical cost is often used for assets with long useful lives and stable values, ensuring consistency and comparability over time. Current value. Reflecting the fair value of assets or liabilities at the reporting date, current value enhances relevance by providing up-to-date information on market conditions. It's particularly useful for assets like marketable securities or commodities whose values fluctuate frequently and can be readily determined from active markets. 4. Factors specific to initial measurement. When initially recognizing an asset or liability, factors such as the reliability of available data, the certainty of future economic benefits, and the cost-effectiveness of using a particular measurement basis should be evaluated. For instance, the initial valuation of intangible assets may involve estimating their fair value based on expected future cash flows, market comparisons, or replacement costs. Number 5, more than one measurement basis. Different measurement bases may be appropriate for different types of assets or liabilities within the same entity, depending on their nature, purpose, and relevance to stakeholders. For example, a company may use historical cost for its property, plant, and equipment, PP&E, to maintain consistency and reliability, while employing fair value for its financial instruments to provide users with current market-based information. By carefully considering these factors, accounting professionals ensure that the chosen measurement basis aligns with the specific attributes of assets and liabilities, enhances the usefulness of financial information, and complies with accounting standards to provide stakeholders with reliable and relevant information for decision-making purposes. Measurement of equity. Equity in financial accounting refers to the residual interest in the assets of an entity after deducting all its liabilities. Here's a comprehensive explanation. Total carrying amount of equity. Equity is not directly measured, but is derived as the residual amount when total assets are reduced by total liabilities. This means equity represents the ownership interest of shareholders in the net assets of the company. General purpose financial statements. Financial statements, such as the balance sheet, are not designed to reflect the total value of an entity directly. Therefore, the total carrying amount of equity typically does not equate to A, the market value of equity shares, B, the amount that could be obtained from selling the entire company as a going concern, C, the amount that could be realized by selling all assets and settling all liabilities. Direct measurement of equity. While some individual classes of equity, such as ordinary shares, preferred shares, and components of equity, such as retained earnings, share premium, can be directly measured and reported separately, at least one class and component of equity must be measured as a residual amount. Positive and negative equity. Normally, the carrying amount of individual classes or components of equity is positive, indicating a positive net worth of the entity. However, under certain circumstances, such as significant losses or liabilities exceeding assets, equity can be negative, implying that liabilities exceed assets. Understanding the measurement of equity is crucial because it reflects the financial health and ownership structure of a company. It helps investors, creditors, and other stakeholders assess the entity's ability to generate future cash flows and its overall financial strength. By ensuring accurate measurement and reporting of equity, financial statements provide transparency and aid in informed decision-making. Cash flow-based measurement techniques. In accounting, cash flow-based measurement techniques are methods used to estimate certain financial measures when direct observation or measurement is not feasible. Here's a thorough explanation. Use in financial reporting. Sometimes, certain financial measures cannot be directly observed, especially when valuing assets or liabilities that do not have readily available market prices. In such cases, cash flow-based techniques are employed to estimate these measures. These techniques are not standalone measurement bases, but rather tools used within existing measurement bases like historical cost or fair value. Application in modified measurement bases. Cash flow-based techniques can modify standard measurement bases to better reflect economic reality or reduce measurement costs. For example, when using a fair value measurement basis, adjustments might be made to exclude the entity's own credit risk, thus refining the fair value estimate. Dealing with outcome uncertainty. One of the key challenges in estimating future cash flows is dealing with outcome uncertainty. This uncertainty arises from the variability in the amount or timing of future cash flows associated with assets or liabilities. Cash flow-based techniques take into account these uncertainties and attempt to provide estimates that are as accurate and relevant as possible. Central estimates versus range of possible outcomes. When using cash flow-based techniques, a central estimate is often derived based on the most likely scenario of future cash flows. This central estimate is selected from a range of possible outcomes that consider various scenarios and probabilities. It represents a point estimate that is deemed most informative for decision-making purposes. However, it's important to note that no single central estimate can fully capture the entire range of possible outcomes. Financial statement users may also require information about the range of possible outcomes to understand the associated risks and uncertainties fully. Benefits and considerations. Cash flow-based measurement techniques can enhance the relevance of financial information by providing estimates that better reflect economic conditions and expectations. They can also potentially reduce costs associated with more complex measurement approaches. Complexity and transparency. While useful, these techniques can increase the complexity of financial reporting. Modifications to standard measurement bases may require additional explanations to ensure transparency and clarity for users of financial statements. By understanding and applying cash flow-based measurement techniques effectively, accountants and financial professionals can provide more accurate and relevant information in financial statements. This supports better decision-making by stakeholders and enhances the overall transparency and reliability of financial reporting. Welcome to today's lecture. Good morning, everyone. I hope you're all ready and excited for today's lecture. We are going to delve into Chapter 7 of our financial reporting course, which is all about presentation and disclosure. This chapter is crucial as it forms the foundation for how financial information is communicated to users, ensuring clarity, relevance, and comparability. Content overview. In Chapter 7, we will cover the following key topics: presentation and disclosure as communication tools, presentation and disclosure objectives and principles, classification, classification of assets and liabilities, offsetting, classification of equity, classification of income and expenses, profit or loss and other comprehensive income, aggregation. Each of these sections is vital for understanding how financial information is organized and presented, enhancing the overall utility of financial statements. Introduction to Chapter 7. Let's dive into the essence of Chapter 7. Presentation and disclosure are essential tools for communicating a reporting entity's financial information. Effective communication ensures that this information is not only relevant, but also faithfully represents the entity's financial position and performance. This involves focusing on presentation and disclosure objectives and principles, rather than adhering strictly to rules. It also means classifying and aggregating information in a way that enhances understandability and comparability without obscuring details. For example, when presenting financial statements, it's important to group similar items together and separate dissimilar items. This helps in providing a clear and accurate picture of the entity's financial health. Moreover, effective communication in financial statements is supported by principles that prioritize entity-specific information over standard descriptions and avoid unnecessary duplication. In this chapter, we will explore how to effectively present and disclose financial information, the importance of classification, and the principles behind aggregation. We will also look into the specific requirements for presenting profit or loss and other comprehensive income. We will cover each title in detail with examples to make these concepts understandable for everyone. By the end of this chapter, you should have a solid understanding of how to present and disclose financial information in a way that is both clear and useful. Let's get started. Presentation and disclosure as communication tools. Introduction. Presentation and disclosure in financial reporting are not merely about showing numbers. They serve as powerful communication tools that convey the financial health, performance, and position of a reporting entity. The primary goal is to make financial information understandable, relevant, and comparable for users, which include investors, creditors, analysts, and other stakeholders. Key concepts. 1. Communication of financial information. Financial statements communicate information about an entity's assets, liabilities, equity, income, and expenses. Effective communication makes the information more relevant and faithfully represents the entity's financial status. It enhances the understandability and comparability of the financial data presented. 2. Effective communication requirements. Focus on presentation and disclosure objectives and principles rather than strict rules. Classify information in a way that groups similar items and separates dissimilar items. Aggregate information such that it is not obscured by unnecessary detail or excessive aggregation. Detailed explanation. Effective communication of financial information. The presentation and disclosure of financial information in statements are essential for making the data comprehensible to users. When financial information is communicated effectively, it becomes more relevant, thereby aiding users in making informed decisions. It also contributes to a faithful representation of the entity's financial reality. Effective communication requires objectives and principles. Instead of following rigid rules, focusing on the objectives and principles of presenting and disclosing information is more beneficial. This approach ensures that the information provided is meaningful and useful to the users. Classification. This involves sorting financial data based on shared characteristics, such as the nature of items, their function within business activities, or measurement methods. Proper classification helps in grouping similar items and separating dissimilar ones to avoid confusion. Aggregation. It is about summarizing financial data to prevent it from being lost in excessive detail or overly aggregated. Finding the right balance ensures that important information is neither hidden nor overly simplified. Examples. Presentation objectives. If a company focuses on presenting its financial information based on objectives, it will provide insights into its financial performance and position in a way that is tailored to the needs of its users. For instance, a tech company might emphasize revenue from software subscriptions separately from hardware sales to give a clearer picture of its income streams. Classification of assets and liabilities. An entity might classify its assets into current and non-current categories. Current assets, like cash and inventory, are expected to be converted to cash within a year. Non-current assets, such as property and equipment, provide long-term benefits. Similarly, liabilities can be classified into current, payable within a year, and non-current, payable after a year. Aggregation of financial data. Aggregating sales data for various regions into a single line item called total sales in the financial statement simplifies the presentation. However, additional notes may provide a breakdown to maintain transparency. For example, total sales might be broken down into North America sales, Europe sales, and Asia sales in the notes section. Constraints and considerations. While effective communication is the goal, there are constraints, such as costs. The benefits provided to users by presenting or disclosing particular information should justify the costs of providing and using that information. Hence, decisions about presentation and disclosure need to balance usefulness and cost-effectiveness. Cost constraints. For example, a small business may find it too costly to disclose detailed segment information that a larger corporation might routinely provide. The cost-benefit analysis helps decide the level of detail that is practical and necessary. Conclusion. In summary, presentation and disclosure as communication tools in financial reporting aim to make financial information relevant, understandable, and comparable. This is achieved by focusing on objectives and principles, classifying similar items together while separating dissimilar items, and aggregating information appropriately. These practices ensure that users can easily interpret the financial data, leading to better decision-making. In the following sections, we will explore these concepts in greater detail, supported by examples to enhance understanding. Presentation and disclosure objectives and principles. Introduction. Presentation and disclosure in financial reporting must balance flexibility and comparability. By understanding the objectives and principles behind these practices, we can ensure that financial statements communicate useful and relevant information effectively. Detailed explanation. Objectives of presentation and disclosure. 1. Flexibility to provide relevant information. Entities need the flexibility to present information that faithfully represents their specific circumstances. This means allowing room for entity-specific information rather than adhering strictly to a standardized format. Example: a startup tech company might highlight its research and development expenses separately to show its commitment to innovation. This flexibility helps stakeholders understand the company's strategic focus and potential for future growth. 2. Requirement for comparability. Financial statements must be comparable across different periods and entities. This comparability allows users to track an entity's performance over time and to compare it with other entities. Example: a manufacturing company must present its financial statements in a way that is consistent with previous periods. If it reports revenue from different product lines, it should continue doing so each year. This consistency enables investors to compare the company's performance year over year. Principles of effective communication in financial statements. 1. Entity-specific information over boilerplate. Entity-specific information is more useful than standardized descriptions. Boilerplate text. Tailored information provides a clearer and more accurate picture of the entity's unique financial situation. Example: instead of using generic phrases like revenue increased due to market conditions, a retail company could specify, revenue increased by 15% due to the successful launch of our new online platform and increased customer traffic during the holiday season. This specificity provides clearer insights into the reasons behind financial changes. 2. Avoidance of unnecessary duplication. Duplication of information in different parts of the financial statements should be avoided. Redundant information can make financial statements harder to understand and may overwhelm users. Example: if a company's balance sheet includes a detailed breakdown of its liabilities, there is no need to repeat the same breakdown in the notes section. Instead, the notes could provide additional context or explanations that complement the main financial statements. Key objectives and principles in detail. Balance between flexibility and comparability. Flexibility allows entities to provide information that is most relevant and faithfully represents their unique circumstances. Comparability ensures that users can compare the financial information of different entities and across different periods effectively. Example: a global corporation operating in multiple sectors might need to provide detailed segment reporting to reflect the diverse nature of its business. This flexibility helps stakeholders understand the performance of each segment. At the same time, the corporation must ensure that its segment reporting is consistent from year to year to maintain comparability. Effective communication principles. 1. Entity-specific information. Financial statements should prioritize entity-specific information over boilerplate language to increase usefulness. Example: a healthcare company might include detailed descriptions of its investment in new medical technologies. Rather than saying, "we invest in technology," it could specify, "we invested $5 million in AI-driven diagnostic tools, which reduced patient wait times by 20%. 2. Avoidance of duplication. Redundant information can clutter financial statements. Avoiding duplication helps maintain clarity and understandability. Example: if an annual report contains a comprehensive overview of a company's sustainability initiatives, there's no need to replicate this information in multiple sections. A single, detailed section on sustainability is more effective and easier for users to digest. Classification and aggregation. Classification involves sorting assets, liabilities, equity, income, and expenses based on shared characteristics. Aggregation is the process of summarizing information to avoid unnecessary detail while still conveying the essential financial data. Example: a real estate company might classify its properties into residential and commercial. Within these classifications, it could aggregate rental income from all residential properties into a single line item in the income statement. Further details, such as income from individual properties, can be provided in the notes if necessary. Conclusion. Understanding the objectives and principles of presentation and disclosure is crucial for preparing effective financial statements. Flexibility and comparability must be balanced to ensure the information is relevant and consistent. Entity-specific information enhances usefulness, while avoiding duplication maintains clarity. Proper classification and aggregation of financial data further aid in effective communication. By adhering to these principles, financial statements can provide a clear, accurate, and comprehensive view of an entity's financial position and performance. Classification Introduction. Classification in financial reporting involves organizing financial data based on shared characteristics. This helps in presenting and disclosing information in a way that enhances understandability, relevance, and comparability. Proper classification ensures that similar items are grouped together and dissimilar items are kept separate, providing a clear and accurate picture of an entity's financial situation. Detailed explanation. Classification of assets and liabilities. Definition. Classification is the sorting of assets and liabilities based on their characteristics, such as nature, role within the business, and measurement methods. Example, current versus non-current assets. Current assets are expected to be converted into cash within a year, e.g., cash, accounts receivable, inventory. Non-current assets provide long-term benefits and are not expected to be converted into cash within a year, e.g., property, plant, equipment. Current versus non-current liabilities. Current liabilities are obligations the entity expects to settle within a year, e.g., accounts payable, short-term loans. Non-current liabilities are obligations that are not expected to be settled within a year, e.g., long-term debt, deferred tax liabilities. Practical example. A retail company classifies its inventory, current asset, separately from its store buildings, non-current asset. Similarly, it classifies its short-term supplier credits, current liabilities, separately from long-term bank loans, non-current liabilities. Offsetting definition. Offsetting occurs when an entity recognizes and measures both an asset and a liability separately, but groups them into a single net amount in the financial statements. This is generally not appropriate as it obscures the individual characteristics of the items. Example. Not offsetting. An entity has an accounts receivable of $50,000 and an accounts payable of $20,000. Instead of reporting a net amount of $30,000, the entity should present both amounts separately to provide a clear view of its receivables and payables. Practical example. A manufacturing company has a bank loan of $100,000 and a bank deposit of $30,000. Instead of reporting a net liability of $70,000, the company should report the loan and the deposit separately in the financial statements. Classification of equity. Definition. Equity classification involves organizing equity claims based on their characteristics, such as legal, regulatory, or other requirements. Example. Types of equity. Common stock represents ownership and voting rights. Preferred stock typically does not confer voting rights, but has a higher claim on assets and earnings than common stock. Retained earnings, cumulative earnings not distributed to shareholders and reinvested in the business. Practical example, a tech company may have common stock, preferred stock, and retained earnings. It should present these components separately in its equity section. For instance, it could show $1,000 in common stock, $500,000 in preferred stock, and $200,000 in retained earnings. Classification of income and expenses. Definition. Income and expenses are classified based on their nature or function within the business. This helps in providing a detailed view of the entity's performance. Example, income, operating income, earnings from primary business activities, e.g. sales revenue. Non-operating income, earnings from secondary activities, e.g. interest income, gains from asset sales. Expenses, Operating expenses, costs incurred in primary business activities, e.g. cost of goods sold, salaries. Non-operating expenses, costs incurred in secondary activities, e.g. interest expense, losses from asset sales. Practical example. A restaurant chain may classify its revenue from food sales as operating income and revenue from renting out event space as non-operating income. Similarly, it classifies food costs and staff wages as operating expenses, while interest on loans is classified as a non-operating expense. Profit or loss and other comprehensive income. Definition. Income and expenses are included either in the statement of profit or loss or in other comprehensive income, OCI. The statement of profit or loss is the primary source of information about an entity's financial performance for the reporting period. Example. Profit or loss includes all income and expenses that determine the net income or net loss for the period, e.g., sales revenue, cost of goods sold, administrative expenses. Other comprehensive income, OCI, includes items that are not included in profit or loss but affect equity, e.g., unrealized gains and losses on certain investments, foreign currency translation adjustments. Practical example. A multinational corporation may report its sales revenue, cost of goods sold, and operating expenses in the profit or loss section. At the same time, it may include foreign currency translation gains and unrealized gains on available for sale securities in the OCI section. Conclusion. Proper classification of financial data into assets, liabilities, equity, income, and expenses is essential for clear and accurate financial reporting. Each category has its characteristics and requires careful consideration to ensure that financial statements provide useful, relevant, and comparable information. By following these principles, entities can communicate their financial position and performance effectively, aiding stakeholders in making informed decisions. Aggregation. Introduction. Aggregation in financial reporting involves summing up individual items that share common characteristics to present a more concise and comprehensible summary. While aggregation helps simplify financial statements by reducing unnecessary detail, it's crucial to balance this with providing enough information to ensure that users can make informed decisions without obscuring important details. Detailed explanation. Purpose and importance of aggregation. Definition. Aggregation is the process of adding together assets, liabilities, equity, income, or expenses that have shared characteristics. This method helps present a clearer and more concise view of an entity's financial position and performance. Example. A company might aggregate all expenses related to marketing into a single line item called marketing expenses, rather than listing each individual expense separately. This helps users quickly understand the total marketing costs without sifting through numerous entries. Practical example. In a retail company's financial statements, the cost of goods sold, COGS, is an aggregated figure that includes the cost of raw materials, labor, and overheads. Instead of detailing each cost separately, COGS provides a single, understandable figure representing the total cost of producing goods sold during the period. Levels of aggregation. Different levels for different parts of financial statements. Aggregation levels can vary depending on the part of the financial statements being presented. Generally, the primary financial statements, balance sheet, income statement, cash flow statement, provide summarized information, while notes and supplementary schedules offer more detailed breakdowns. Example, balance sheet. Aggregates assets into categories like current assets and non-current assets. Aggregates liabilities into current liabilities and non-current liabilities. Income statement. Aggregates revenues and expenses into categories like operating revenue, operating expenses, non-operating income, and non-operating expenses. Practical example. A manufacturing company's balance sheet might show property, plant, and equipment as a single line item, aggregating all its physical assets. In the notes, it provides a detailed breakdown of this figure into land, buildings, machinery, and equipment. Balancing detail and summary. Finding the right balance. Effective aggregation involves striking a balance between summarizing information and providing enough detail to avoid obscuring significant data. Over-aggregation can lead to loss of important information, while under-aggregation can overwhelm users with too much detail. Example: over-aggregation. Reporting a single figure for general expenses without breaking it down can obscure significant expenses like legal fees, research costs, or travel expenses, which might be relevant for users to know. Under-aggregation. Listing every minor office supply purchase separately in the financial statements would clutter the report, making it difficult for users to see the bigger picture. Practical example: a tech company might report research and development expenses as an aggregated figure in its income statement. However, in the notes, it can provide a breakdown showing how much was spent on different projects, salaries, and equipment. This approach maintains clarity while ensuring that users have access to detailed information if they need it. Conclusion: aggregation is a critical practice in financial reporting that helps present a clear and concise summary of an entity's financial data. By aggregating items with shared characteristics, financial statements become more understandable and easier to analyze. However, it is essential to find the right balance between providing a high-level summary and offering enough detail to ensure that no significant information is obscured. Through careful aggregation, entities can effectively communicate their financial position and performance, aiding stakeholders in making well-informed decisions. Summary of Chapter 7, Presentation and Disclosure. Welcome to today's lecture. In Chapter 7, we explored the crucial aspects of presentation and disclosure in financial reporting. This chapter provides a comprehensive understanding of how to effectively communicate financial information to users through financial statements. Key topics covered. 1. Presentation and disclosure as communication tools. Financial statements communicate information about an entity's assets, liabilities, equity, income, and expenses. Effective communication enhances the relevance, understandability, and comparability of financial information. 2. Presentation and disclosure objectives and principles. Balancing flexibility and comparability ensures that financial statements provide useful, faithful representations of an entity's financial position. Emphasis on entity-specific information over boilerplate text and avoiding unnecessary duplication enhances the clarity and usefulness of financial statements. 3. Classification. Proper classification of assets, liabilities, equity, income, and expenses helps in organizing financial information based on shared characteristics. Offsetting, classification of equity, and income and expenses were discussed to ensure that financial data is presented in a clear and distinct manner. 4. Aggregation. Aggregation involves summarizing items with shared characteristics to present a concise and understandable view of financial data. Finding the right balance between summarizing and providing detailed information ensures that important data is not obscured while maintaining clarity. Conclusion. By understanding the principles and objectives of presentation and disclosure and the methods of classification and aggregation, we can prepare financial statements that effectively communicate an entity's financial situation. This chapter equips us with the knowledge to present financial information in a way that is both useful and comprehensible to stakeholders. Thank you. Thank you for your attention and participation in today's lecture. We will see you in the next and final chapter, Chapter 8, where we will conclude our exploration of the conceptual framework for financial reporting. See you next time. Hello, students. Welcome to today's lecture on Chapter 8 of the Conceptual Framework for Financial Reporting. This is our final chapter, and we will be exploring the concepts of capital and capital maintenance. This chapter is essential for understanding how companies maintain and report their financial health over time. Content overview. In this chapter, we will cover the following key topics. 1. Concepts of capital. Understanding the financial and physical concepts of capital. How entities choose the appropriate concept of capital based on user needs. 2. Concepts of capital maintenance and the determination of profit. Financial capital maintenance and physical capital maintenance. The importance of these concepts in linking capital and profit. 3. Capital maintenance adjustments. Adjustments related to the revaluation or restatement of assets and liabilities. The impact of these adjustments on equity and profit reporting. Introduction to Chapter 8. Concepts of capital. A financial concept of capital equates capital with the net assets or equity of the entity, often used by entities in preparing financial statements. This concept focuses on invested money or purchasing power. On the other hand, a physical concept of capital considers the productive capacity of the entity, such as the units of output per day. The selection of the concept depends on the primary concerns of the users of financial statements, whether they focus on nominal invested capital, purchasing power, or operating capability. Concepts of capital maintenance and the determination of profit. Capital maintenance is crucial for determining profit accurately. It involves maintaining either the financial or physical capital of the entity over a period. Financial capital maintenance measures profit based on the increase in net assets, while physical capital maintenance measures profit based on the increase in productive capacity. This distinction helps in understanding whether profit is derived from maintaining the capital's purchasing power or its physical capacity. Capital maintenance adjustments. These adjustments arise from revaluations or restatements of assets and liabilities. While they affect equity by increasing or decreasing it, they are not included in the income statement under certain concepts of capital maintenance. Instead, these adjustments are reflected in equity as capital maintenance adjustments or revaluation reserves. Conclusion. This chapter provides a foundational understanding of how companies manage and report their capital and profits. By grasping these concepts, you will be better equipped to analyze and interpret financial statements accurately. Concepts of capital. Understanding the concepts of capital is fundamental to financial reporting because it defines the value and capacity of an entity. The two main concepts of capital are the financial concept of capital and the physical concept of capital. Each concept is suited to different needs of users of financial statements, and the choice between them depends on the entity's goals and the concerns of its stakeholders. Financial concept of capital. The financial concept of capital is the most commonly adopted by entities. Under this concept, capital is synonymous with the net assets or equity of the entity. In simpler terms, capital is represented by the monetary value of what the entity owns, assets, minus what it owes, liabilities. Invested money. This perspective views capital as the total amount of money invested in the entity. This includes both the initial funds contributed by the owners and any retained earnings, profits that have been reinvested in the business rather than distributed as dividends. Example. Imagine a company, ABC Corporation, with assets worth $5 million and liabilities worth $2 million. The net assets, or equity, of the company are $3 million, $5 million minus $2 million. This $3 million represents the financial capital of ABC Corporation, indicating the total invested money. Invested purchasing power. This perspective considers the purchasing power of the money invested, which means adjusting for inflation or changes in the value of money over time. This ensures that the capital reflects its real value, not just its nominal value. Example, suppose DF Corporation was started with $1 million. After a year, due to inflation, the purchasing power of that $1 million has decreased by 10%. If DEF Corporation adjusts its financial statements for this inflation, it shows that to maintain the same purchasing power, the company now needs to have $1,100,000, 10% more than the original $1 million. Physical concept of capital. The physical concept of capital views capital as the productive capacity of the entity. This concept is focused on the ability of the entity to generate goods and services, often measured by the physical units of output, such as units produced per day. It's more about maintaining the operational capability of the entity. Operating capability. This perspective considers capital as the entity's ability to sustain its operations and production levels. It's about keeping the machinery, equipment, and other physical resources in good working condition to maintain production levels. Example, XYZ Manufacturing has machinery that produces 10,000 units of product per day. The physical capital of XYZ Manufacturing is its ability to produce these 10,000 units daily. If XYZ Manufacturing maintains or increases this production capability over time, e.g. by repairing or upgrading machinery, it is said to maintain its physical capital. Selection of concept based on users' needs. The choice between a financial or physical concept of capital depends on what the users of the financial statements are primarily concerned with. Financial concept. This is appropriate if users are mainly concerned with the monetary value of their investments or the purchasing power of their invested capital. Investors and financial analysts typically prefer this concept because it focuses on the value of their shares and the dividends they receive. Example, investors in GHI Corporation are primarily concerned with the value of their shares and the potential dividends. Therefore, GHI Corporation adopts the financial concept of capital, focusing on maintaining and growing the monetary value of its net assets. Physical concept. This is suitable if users are primarily concerned with the entity's ability to maintain its production capacity and operational capabilities. Operational managers and production planners usually prefer this concept because it focuses on the entity's ability to continue producing goods and services efficiently. Example, stakeholders of JKL Manufacturing, such as operational managers, are primarily concerned with maintaining the company's ability to produce goods efficiently. JKL Manufacturing adopts the physical concept of capital, focusing on maintaining its machinery and production facilities to ensure continuous and efficient production. Measurement difficulties. Each concept has its own measurement challenges, which need to be addressed carefully to ensure accurate financial reporting. Financial concept. Measuring invested money and purchasing power accurately requires adjustments for inflation and other economic factors. This ensures that the financial statements reflect the true value of the entity's capital. Example, M&O Retail uses the financial concept of capital. To account for inflation, the company adjusts its financial statements to reflect the changing value of money over time. If inflation is 5%, the company increases the value of its assets accordingly to maintain the purchasing power of its capital. Physical concept. Measuring productive capacity involves estimating future output and considering factors such as machinery wear and technological advancements. This ensures that the entity maintains its operational efficiency. Example, PQR Energy uses the physical concept of capital. The company regularly assesses its equipment to ensure it can maintain its current level of energy production. If new technology emerges that enhances production efficiency, PQR Energy considers investing in this technology to maintain or increase its productive capacity. By understanding these concepts and their applications, entities can better determine how to maintain and report their capital, ensuring they meet the needs of their financial statement users. This understanding helps in making informed decisions that align with the goals of the entity and the expectations of its stakeholders. Concepts of capital maintenance and the determination of profit. The concepts of capital maintenance and the determination of profit are crucial for understanding how an entity measures and maintains its capital over time. These concepts help distinguish between the entity's return on capital and its return of capital. There are two main concepts of capital maintenance: financial capital maintenance and physical capital maintenance. Each has its own way of defining profit and maintaining capital. Financial capital maintenance. Financial capital maintenance focuses on maintaining the monetary value of the entity's net assets. Under this concept, a profit is earned only if the financial or money amount of the net assets at the end of the period exceeds the financial or money amount of the net assets at the beginning of the period, after excluding any distributions to and contributions from owners during the period. Nominal monetary units. This approach measures capital in terms of the nominal money value. It does not adjust for changes in the purchasing power of money due to inflation. Example, imagine XYZ Corporation starts the year with $3 million in net assets. During the year, it earns $1 million in profits and distributes $500,000 to shareholders as dividends. At the end of the year, its net assets are $3,500,000. $3 million plus $1 million minus $500,000. Since the ending net assets exceed the beginning net assets, XYZ Corporation has maintained its financial capital and earned a profit. Constant purchasing power. This approach adjusts the monetary value to account for changes in the purchasing power of money due to inflation. It ensures that the capital maintains its real value over time. Example, ABC Corporation starts the year with $2 million in net assets. During the year, it earns $600,000 in profits, but inflation is 10%. To maintain the purchasing power of its capital, the company needs to have $2,200,000, 10% more than $2 million at the end of the year. If ABC Corporation ends the year with $2,400,000 in net assets, it has maintained its financial capital in constant purchasing power terms and earned a profit of $200,000. $2,400,000 minus $2,200,000. Physical capital maintenance. Physical capital maintenance focuses on maintaining the entity's productive capacity. Under this concept, a profit is earned only if the physical productive capacity or operating capability of the entity at the end of the period exceeds the physical productive capacity at the beginning of the period, after excluding any distributions to and contributions from owners during the period. Operating capability. This approach measures capital in terms of the entity's ability to produce goods and services. It considers factors like machinery efficiency and production capacity. Example, DF Manufacturing starts the year with machinery that produces 10,000 units per month. During the year, it upgrades its machinery, increasing production capacity to 12,000 units per month. If the productive capacity at the end of the year is 12,000 units per month, 2,000 units more than at the beginning, DF Manufacturing has maintained its physical capital and earned a profit in terms of increased production capacity. Differences between financial and physical capital maintenance. The principal difference between the two concepts lies in how they treat the effects of changes in the prices of assets and liabilities. Financial capital maintenance, nominal monetary units. Profit represents the increase in nominal money capital over the period. Holding gains, increases in the prices of assets held over the period, are considered profits, even if they are not realized through sales. Example, GHI Investments holds assets worth $1 million. By the end of the year, the value of these assets increases to $1,500,000 due to market conditions. Under financial capital maintenance, the $500,000 increase is considered profit, even if GHI Investments has not sold the assets. Financial capital maintenance, constant purchasing power. Profit represents the increase in invested purchasing power. Only the part of the increase in the prices of assets that exceeds the general level of inflation is regarded as profit. Example, JKL Retail holds inventory worth $1 million. By the end of the year, the value of this inventory increases to $1,300,000, but the inflation rate is 10%. To maintain purchasing power, the inventory needs to be worth $1,100,000, 10% more than $1 million. Therefore, the profit is $200,000, $1,300,000 minus $1,100,000. Physical capital maintenance. Profit represents the increase in the entity's physical productive capacity. All price changes affecting the assets and liabilities are viewed as changes in the measurement of the physical productive capacity and are treated as capital maintenance adjustments rather than profit. Example: MNO Energy starts the year with machinery capable of generating 1,000 megawatts of power. During the year, it acquires new technology that increases capacity to 1,200 megawatts. The additional 200 megawatts represent an increase in physical productive capacity, indicating profit under the physical capital maintenance concept. Capital maintenance adjustments. Capital maintenance adjustments are changes in equity resulting from the revaluation or restatement of assets and liabilities. These adjustments are part of equity and not considered profit under certain concepts of capital maintenance. Revaluation reserves. These are increases in equity resulting from the revaluation of assets to reflect their current market value. They are treated as capital maintenance adjustments and not included in profit. Example: PQR Properties owns a building originally valued at $1 million. At the end of the year, the market value of the building increases to $1,500,000. The $500,000 increase is recorded as a revaluation reserve in equity, not as profit. Restatements for inflation. These are adjustments made to ensure the financial statements reflect the real value of assets and liabilities, taking into account changes in the purchasing power of money. Example: STU Corporation holds inventory valued at $1 million. Due to a 20% inflation rate during the year, the value of the inventory in constant purchasing power terms is $1,200,000. The $200,000 increase is recorded as a capital maintenance adjustment, ensuring the financial statements reflect the real value of the inventory. By understanding these concepts and examples, students can grasp how entities measure and maintain their capital, determine profit, and make adjustments to ensure accurate financial reporting. This knowledge is essential for making informed financial decisions and understanding the financial health of an entity. Capital maintenance adjustments. Capital maintenance adjustments involve the revaluation or restatement of assets and liabilities to reflect changes in their value. These adjustments are crucial for ensuring that the capital of an entity is maintained in real terms, and they help distinguish between true profit and changes in capital. Under certain concepts of capital maintenance, these adjustments are part of equity rather than being included in the income statement. Revaluation of assets and liabilities. Revaluation of assets and liabilities occurs when their carrying amount in the financial statements is adjusted to reflect their current market value. This process ensures that the financial statements provide a true and fair view of the entity's financial position. Example: DF Properties owns a piece of land initially valued at $2 million. Over the year, the market value of the land increases to $2,500,000. DF Properties revalues the land to its new market value. The $500,000 increase is recorded as a revaluation reserve in equity, ensuring that the financial statements reflect the true value of the land. Restatement for inflation. Restatement for inflation adjusts the carrying amounts of assets and liabilities to account for changes in the purchasing power of money. This ensures that the financial statements reflect the real value of the entity's assets and liabilities. Example: GHI Manufacturing holds machinery valued at $3 million. During the year, the inflation rate is 10%. To maintain the real value of its machinery, GHI Manufacturing restates the value to $3,300,000, $3 million plus 10%. The $300,000 increase is recorded as a capital maintenance adjustment, ensuring the financial statements reflect the real value of the machinery. Capital maintenance adjustments in equity. Increases or decreases in equity resulting from revaluation or restatement are treated as capital maintenance adjustments. These adjustments ensure that the entity's capital is maintained in real terms and distinguish between profit and changes in capital. Example: JKL Enterprises holds investment properties initially valued at $4 million. At the end of the year, the market value of these properties increases to $4,800,000. JKL Enterprises records the $800,000 increase as a revaluation reserve in equity, not as profit. This capital maintenance adjustment ensures that the financial statements accurately reflect the increase in the value of the properties. Importance of capital maintenance adjustments. Capital maintenance adjustments are vital for several reasons. 1. Accurate financial reporting. They ensure that the financial statements present a true and fair view of the entity's financial position by reflecting the current value of assets and liabilities. 2. Distinguishing profit from capital changes. By recording revaluation and restatement adjustments in equity, these adjustments help distinguish between true profit and changes in the value of the entity's capital. 3. Inflation accounting. In periods of high inflation, restatement for inflation ensures that the financial statements reflect the real value of assets and liabilities, maintaining the purchasing power of the entity's capital. Summary. Capital maintenance adjustments involve revaluing or restating assets and liabilities to reflect their true value. These adjustments are recorded in equity rather than the income statement, ensuring accurate financial reporting and maintaining the real value of the entity's capital. Understanding these adjustments is essential for distinguishing between profit and changes in capital, which is crucial for making informed financial decisions. Brief summary of Chapter 8. Chapter 8 of the Conceptual Framework for Financial Reporting covers three main topics: concepts of capital maintenance, and the determination of profit and capital maintenance adjustments. Concepts of capital. This section explains the difference between financial and physical concepts of capital. Financial capital relates to the net assets or equity of the entity, while physical capital pertains to the entity's productive capacity. Concepts of capital maintenance and the determination of profit. This section discusses how entities can maintain their capital and determine profit. It introduces financial capital maintenance, focused on the monetary value of net assets, and physical capital maintenance, focused on maintaining productive capacity. Examples illustrate how profit is determined under each concept. Capital maintenance adjustments. This section covers the adjustments made to reflect the true value of assets and liabilities. These adjustments are recorded in equity to ensure accurate financial reporting and maintain the real value of capital. Thank you for completing the course on the Conceptual Framework for Financial Reporting. We hope you found it informative and useful. Join us for our next course, where we will provide a complete introduction and interpretation of IFRS, International Financial Reporting Standards, and IAS, International Accounting Standards. See you there. What is the conceptual framework and why is it important? The Conceptual Framework for Financial Reporting is like a guidebook used by accountants and organizations to create financial reports. It explains the goals and ideas behind these reports and is important for several reasons. 1. Helping the IASB develop standards. IASB stands for International Accounting Standards Board. The IASB creates the rules, called IFRS standards, that accountants follow to prepare financial reports. The conceptual framework ensures that these rules are based on consistent and logical principles. MARB 2. Helping companies. When there isn't a specific rule for a particular situation, companies can refer to the conceptual framework to decide how to account for it. This helps companies make consistent and reliable financial decisions. 3. Helping everyone understand. The framework makes it easier for everyone, including investors and regulators, to understand and interpret the financial reporting rules. Key points to remember. Not a set of rules. The conceptual framework is not a rule book itself. It doesn't override any existing rules, IFRS standards. Exceptions. Sometimes, the IASB might create a rule that differs from the framework. If this happens, they will explain why. Updates. The framework can be updated based on experience, but updates don't automatically change the rules. Changing a rule requires a formal process. How the framework supports the mission of the IFRS Foundation. The IFRS Foundation is the organization that oversees the IASB. Their mission is to develop rules that promote transparency, accountability, and efficiency in global financial markets. The conceptual framework helps support this mission by 1. Enhancing transparency. Transparency means making financial information clear and easy to understand. The framework helps improve the quality and comparability of financial information globally, allowing investors to make better informed decisions. 2. Strengthening accountability. Accountability means making sure that managers and companies are responsible for their financial decisions. The framework reduces the information gap between investors who provide the capital and managers who use the capital, helping to hold management accountable. It also provides important information for regulators, those who oversee financial markets. 3. Improving economic efficiency. Economic efficiency means using resources in the best possible way. The framework helps investors identify opportunities and risks worldwide, improving how capital money is allocated. For businesses, using a single set of accounting standards reduces costs and simplifies international reporting. Summary of acronyms. IFRS, International Financial Reporting Standards. IASB, International Accounting Standards Board. IFRS Foundation, the organization that oversees the IASB and the development of IFRS standards. In summary, the conceptual framework is like a foundational guide that helps create clear, consistent, and reliable financial reporting rules. It helps the IASB develop these rules, helps companies apply them when there's no specific rule, and helps everyone understand